Good afternoon. I am Lucio Penck. I'm standing in for my colleague, Bruegel colleague, Jakob Kirkgaard, who is on the program but was not able to make it on time. He will be here later. So I have the pleasure to moderate the second session of our conference, which is about geopolitical risk, very much a topical issue, as we heard, in their implication for finance, trade, and macroeconomic growth. And we are happy to have a very distinguished set of speakers. Enrico Mallucci of the Central Bank of Ireland, Raffaele Giuliana of the ESRB, and I think the only non-Italian on the podium, Galip Kemalozan of the IMF. So without further ado, I give the floor to Enrico, who will be speaking about evidence for international portfolio allocation, about geopolitical risk. I've been asked to keep the time, so I stress not to go beyond 20 minutes in principle, also to leave some time for the discussion afterwards. So the floor is yours.
All right, thank you very much. Thanks for the invitation. It's a real pleasure to be here. As you mentioned before, the paper I'm presenting today is about geopolitical risk and its effect on portfolio allocation. I'm Enrico Mallucci, and this is joint work with Nathan Converse from the Federal Reserve. All right, let me first give you some motivation and intuitions behind this paper. So, as you might have noticed, the world has become a dangerous place. So, Russia's invasion of Ukraine and the war in Gaza, they have sent geopolitical risk indices to the roof. And at the same time, they are testing the world order as we know it. And of course, most recently, and by most recently I mean maybe today, even NATO, which has kept like the geopolitical order for the last 60 years, is showing some cracks as the US engage in a trade war with its allies. And of course, the problem of this rising geopolitical tension is that economic agents may start to take action to mitigate their exposure to geopolitical risk. So think about firms, right? There has been this debate of reshaping global value chain so that firms may bring production closer to home and cut back their dependence on non-allied countries. But the problem is that if you take this kind of measures, then you end up with a more fragmented world, which we kind of agree is bad for growth and is bad for price stability. So in this paper, I'm also going to touch upon fragmentation, but we focus on the financial side of the economy. In particular, we leverage on a granular database containing monthly data on the portfolio holdings of international bond funds. And we study the impact of geopolitical risk on the portfolios of these international investors. The way we structure this paper is in 3 layers, going from a very granular question to a more broad and aggregated question. So at the very first layer, at the more disaggregated one, at the more granular level, we want to understand how fund managers modify their portfolio weight of a country when that country becomes more exposed to geopolitical risk. So we really want to understand how the match between fund manager and countries work. Then at the second level, and slightly more aggregated, we want to understand how this political risk changes the composition of the portfolio at a more aggregate level. So we want to understand if there is evidence of fragmentation. So we see, for instance, fund manager investing in less countries and having more concentrated portfolios. So this is the kind of question we ask in the second layer. And as a third layer, hopefully we get there, I don't know with the time, we want to study how do end investors modify injection into funds in response to geopolitical risk. So we move from fund managers to end investors in the last level of the analysis. literary review, I'm going to skip it, but what I want to say before I jump into the fine details of the paper is that this is, of course, an empirical paper. So the data is important. So the data that we put together is based essentially on two sets of variables. The first set of variables is data on country-specific and worldwide geopolitical risk. We take an index for geopolitical risk that we borrow from my former colleagues from the Federal Reserve, Dario Caldara and Matteo Iacoviello, and we merge this data with micro-level data on the portfolios of international mutual bond funds. Let me show you a couple of things about the data that I think are going to be interesting for the rest of the presentation, if you can still hear me.
Yes.
Yeah. So this is the Global Geopolitical Risk Index. So this is Geopolitical Risk Index for the global economy. Okay, so this is pulling together all the countries. The way Matteo and Dario built this geopolitical risk index is by using textual analysis tools. So essentially they check in Anglophone newspapers how many times the name of a country comes next to some keywords such as bombing, terrorism, war. And they use this information to build this index. And here you have the index for the world. And what you see is non-linearity, right? So you see that this index is very stable for most of the time, and then it spikes all of a sudden. So non-linearity is a key aspect of geopolitical risk. The second thing, and this is going to be interesting for our paper, is that geopolitical risk, of course, you think it's a global phenomenon, right? The geo part of geopolitical refers to the global aspect of this phenomenon, but actually the way countries are exposed to this geopolitical risk changes a lot. So here I have plotted in red the geopolitical risk index for emerging European countries. In green, the geopolitical risk index for Middle East and African countries, and in black, the same index for emerging Asia. So you see that if you look at the Ukraine war, well, you see that emerging Europe was very exposed to it, of course, but then you see that Middle East and Africa and emerging Asia, you don't see any spike there. And for the Gaza war, you see the opposite. So you see a lot of happening for Middle East and Africa, but not much for the other countries. So this is just to say that, again, geopolitical risk is global, but the way countries are exposed is not the same. And we are going to actually exploit this heterogeneity in our identification strategy, because we are going to exploit the different impact of geopolitical risk on different countries to see how portfolio weights get adjusted. All right, then very briefly on the second set of data, which is mutual fund portfolios. So we take from EPFR. We have end-of-month snapshot of the portfolio of investment funds detailing allocation to each destination countries. And in this work, we focus on international bond funds that actively manage their portfolios and reside in Anglophone countries and in Luxembourg. And the reason why we choose Anglophone countries is because we want to be symmetric with our geopolitical risk index, which is based on Anglophone newspapers. All right, I'm going to skip also this slide. I'm going to talk very shortly about the econometric specification, so try not to be too worried, and then I'm going to jump into the results. So we derive our specification from an identity, which is the law of motion of portfolio weight, that we log linearize and rearrange so that it looks like the equation you have here in the slide. This equation tells you that the portfolio weight of country J at time t in fund I is equal to a function of past portfolio weight, excess returns of country J relative to the other countries in the portfolio. This is the term in brackets. And then our geopolitical risk index. And to conclude, a bunch of factors that are specific to the fund country match and time. So two things that are important here. The first one is that, of course, our variable of interest is going to be GPRC, and our coefficient of interest is going to be this gamma, right? And the second thing I want to mention as briefly as I can is that we also include these excess returns in the regression, because there are two. If you think about the way portfolio weights evolve over time, is that they also depend on returns, right? So suppose you are an investor and you invest both in France and Greece, right? And then Greece pays a higher return. Then over time, the weight of Greece is going to increase in your portfolio, right? But this is just like a mechanical effect that doesn't is not based on the decision of the fund manager to actually allocate the resources. So this is why we have this term in the regression, because we want to control for this mechanical effect and focus instead on the gamma. Okay, so without further ado, let's go to the results. The first table I'm going to show you is just coefficient estimate for the regression equation I just showed you, right? So we have past portfolio weights, we have excess returns, and then we have the GPRC variable, right? Which is the important one. So the GPRC variable, the geopolitical risk variable, is negative and significant. So it means that fund manager reduce the weights of countries when geopolitical risk increase in that country. But then the question is, how big is this effect, right? And actually, the impact is pretty modest. So 200% increase of GPRC, which is roughly an increase which is comparable to one standard deviation of the GPRC measure, leads to a 1.3% decline of portfolio weights. Okay, so it's measurable, but is not huge. But then the question is also like, how persistent is this, right? So is this like something that vanishes after just a couple of months, or do we see some persistence? And here we run a look. In this slide, I have the impulse response function for portfolio weight following a geopolitical risk shock. We use local projection method to create this graph. And what you see is something pretty interesting, right? So you see two things. The first thing is that the impact of geopolitical risk is persistent, and the second thing is that it gets bigger over time. So you actually have the peak impact after 10 to 12 months from the initial shock. And if I do the same exercise to quantify the magnitude of this shock on the portfolio weight, then I get that a 200% increase of GPRC leads to a 3.8% decline of portfolio weight. Okay, and is this big? Is this small? Well, it's actually not that small, because we have an example of Brazil putting capital controls at some point. And what happened after they put capital controls is that their portfolio weight, on average, in the portfolios of these funds that we see, declined by about 3%. Okay, so here we are talking of like something that is of about that order of magnitude. So it's not completely, it's not something that you can completely forget about. So just to reiterate the point, geopolitical risk has a persistent impact on weights, and it's pretty sizable after 1 year. Here we also do a couple of more exercises in trying to understand if geopolitical risk matters more for some country or the others. Here you have a bar chart that gives you essentially the response of a one standard deviation increase in geopolitical risk, and then we partition our sample to look at specific groups of countries. And what you see is that when you have an increase of geopolitical risk in the US and in the advanced economies, so the second and the third bar, you don't get much, and if you get something, is actually positive. Okay, and this is like a pretty actually standard result, because it's this like flight to safety story, right? That even if the US goes belly up, I mean, people still invest in the US because it's still comparably the best place to invest, right? But then if we look at the emerging market, there is where we see the problem, right? So we see big negative numbers, especially in emerging Europe. The other thing that we do as an exercise is to exploit and try to understand a little bit better this idea that geopolitical risk is non-linear, okay? So remember when I showed the first slide with geopolitical risk, I pointed out that geopolitical risk is non-linear, right? And then the question is, how does the level, so how does the reaction of portfolio changes with the level of geopolitical risk, right? Given that the level of geopolitical risk can change so much, right? And to understand this, we create a dummy variable that is equal to 1 when geopolitical risk is in the top quartile of the distribution, and we interacted with our main regressor, geopolitical risk. And this is what we have. We have that the geopolitical risk variable becomes insignificant, while the interaction term is negative, significant, and large. Okay, so this means that is essentially extreme episode of geopolitical risk that drive the relationship between weights, portfolio weights, and geopolitical risk. So in some sense, I think that the title of this conference, which is Extreme Geopolitical Tension, it's really fits very well with this paper, because our message is also that extreme geopolitical risk is what we should be concerned about. Then here we also explore to what is exactly the definition of geopolitical risk, but we can talk about this over dinner and over lunch, because I mean time is limited. So I also want to talk briefly about the last 2 layers of the analysis. So the first one is about the portfolio compositions. So again, the question we're trying to understand here is like, our portfolio becoming more fragmented as a consequence of geopolitical risk? And to answer these questions, we analyze how global geopolitical risk, as well as the exposure of funds to geopolitical risk, so the geopolitical risk specific to funds, affect things like the number of countries in the portfolio concentration, cash holdings, and the political distance of the portfolio from the US, which is we measure as the weighted average of the political distance of countries in the portfolio from the US using UN voting data. And this is what we find. Please concentrate on the third row, so the one with GPRW. We find that when geopolitical risk increases, the number of countries, the number of destination countries in portfolios decline. The Herfindahl-Hirschman index for the portfolio concentration increases. Cash holdings increase, and the average political distance from the US declines. So we interpret this as clear indication that there is fragmentation, because fund managers, what they do, they cut back their holding, they reduce the number of countries they invest to, and they try to invest in countries that are closer to the US. And here we are looking at funds that most of them are domiciled in the US. So this is a clear indication, we think, of fragmentation. And then, if I don't go too much over time, I'm going to wait until, okay. I'm going to talk briefly about the end investors and what they do. So the last bit of the analysis, we look at how end investors react to geopolitical risk. So in particular, we want to see if funds that are more exposed to geopolitical risk receive less injections. And this is what we find. Please concentrate on the first column. So the dependent variable here is the flows into funds as a percentage of the asset under management of the fund. And then we have a bunch of regressors. So, but the important one, the important ones are the first 3, which essentially are a measure of the exposure of the funds to geopolitical risks. So what you see is that you have a negative and significant coefficient for this fund-specific exposure to geopolitical risks. So we see that injections decline when you have towards funds that are more exposed to geopolitical risk. But what is also interesting is that if we look at the same variable lagged by 2 periods, we find a positive and significant coefficient. So we see essentially that fund flows decline on the impact, but recover very quickly. Okay, and this we find very interesting in relationship with the behavior of fund managers, because fund managers, they actually do something completely different. They don't react much at the beginning, and then over time, they converge to a new equilibrium that is persistent with smaller portfolio weights. Instead, and investor, if you want, they are more hysterical. They react a lot right away, and then they correct the reaction after a couple of months. All right, so in conclusion, the impact of geopolitical risk on portfolio weights is negative, persistent, and statistically significant. On the impact, geopolitical risk only affects portfolio weights modestly, but over the course of 1 year, the impact becomes sizable. There are places where geopolitical risk matters more, and these are emerging markets. And there are periods in time when it matters more, and this is when the level of geopolitical risk is high. And then we also find evidence of financial fragmentation, and we find evidence that fund flows also decline in response to geopolitical risk. Thank you.
Many thanks, Enrico, for a compact presentation. Putting a lot of things in a compact format. Now is for Raffaele Giuliana to present on trade and financial ties with geopolitically distant countries.
Many thanks. Okay, the audio is really good, and thanks for the invitation. And it's certainly my pleasure to present this this content here, which is a compendium of several analyses that myself and colleagues are doing at the ESRB. So many thanks, of course, also to the colleagues listed in the first slide, and the usual disclaimer applies. The content of this presentation does not necessarily reflect the views of the ESRB. And straight to the agenda. So hopefully at the end of this presentation, I will have managed to hopefully to provide fruitful thoughts on 3 main themes. The first theme is the fact that the perception of geopolitical risks have been severe in the last years, and this erodes with the apparent calm in the financial markets, and this may underline risk of disorderly market corrections. The second theme means that we consider this risk of disorderly market corrections, and this makes even more important to explore the empirical impact of geopolitical risk on the euro area in terms of economic and financial stability. Third theme, we try to go beyond the euro aggregate by exploring the cross-country heterogeneity. And first section, first of all, severe concerns about geopolitics. This is corroborated by the left-hand chart, which shows the Google trends for geopolitical risk, and it shows that after the wake-up call of 2022, now the attention to geopolitical risk among the general population has surged to the highest historical levels. And on the right, there is something that is very important for financial markets. There is the BOFA Global Fund Manager survey indicates that themes related to geopolitics in the form of trade wars or geopolitical conflicts have been representing the main tail risks in the last months and also in the last years. Okay, tail risks are important because they may not be fully priced by the markets. And indeed, in this slide, I would like to convey the fact that financial markets have been showing positive performance, especially since the beginning of 2023. In fact, the chart on the left generally shows that stock markets in the US and also in Europe have reached levels that are close to historical highs. Whereas on the right-hand side, we show that the EU and US corporate high-yield bond spreads have been decreasing to very low levels. And if we have this evidence, and the evidence that there is the convergence of several major economic concerns in terms of military or tariff shocks or interest rates surge, we might have this idea that some risks are not fully priced. And the reason is that this risk, also talking to market intelligence, these risks tend to be dichotomic risks. So to some extent, in the long run, they are difficult to price. And also there is the expectation in some cases that sovereign will step in if needed in some cases, which may create slow movements in the pricing of these risks. So in the view of this potential risk of market repricing and sudden market repricing, it's very important to explore from an empirical perspective the impact of geopolitical risk on euro area aggregates. And fortunately, we have seen a very interesting presentation, part of the presentation already about the caldera Jacobiello. But here, what we are saying is that these models have been have proven to be very effective in detecting spikes. And they have been relying on a very solid source of information. It's also true that depending on the use that we want to do, like if we want to assess the current level of the risk, say in Europe compared to 30 years ago, then some questions may arise. And for instance, the average current level is it's pretty close or sometimes lower compared to the levels observed during the Falkland War or the Gulf and Berlin Wall fall. Okay, so it's interesting to at least have a complementary perspective on these indicators, and that's what we did at the ESRB. So we created two alternative measures. The first is a measure based on company reports, based on the idea that sometimes it's useful to take the concerns from the official communication of the listed firms, because those are the most important agent in the economy, at least the ones that may move more quickly the markets. And we created the yellow line here that is a company report index based on earnings calls, and this is based on the mentioning of geopolitical themes, geopolitical words related to risk concepts. And you can notice that in the last 2 years, we reached the levels that were not seen since 2002. There are several drawbacks, of course, with the figures that we have created. The second measure is trade-weighted geopolitical risk based on the caldera Jacobiello again, based on the intuition that the geopolitical risk of a third country with which a given country is trading, it's an important measure, and it's more important today compared to the 70s, given that the international trade has increased a lot. And we use the first of these alternatives, that is the measure based on the company reports. And in our empirical analysis, of course, we have to create a shock, a hypothetical shock. Preferably, this shock has to be extreme but realistic. What we did is to impose a 3 standard deviation shock for 5 periods, 5 quarters. And you can notice that in the latter part of this chart, of this time series, after 2025, there is this spike in this hypothetical spike. Hopefully, it will not materialize. But this spike creates a geopolitical shock that overall this creates an area of additional geopolitical risk that is similar to the shock created by the Russian invasion of Ukraine. Okay, just to give a reference point. And in this way, we create a moderate GPR series and adverse GPR series. We need to have an empirical model that is reliable enough in order to study the impact of these hypothetical geopolitical shock on relevant macro-financial variables. And in this case, what we did is to use the quantile VAR that has been designed in particular by this very brilliant ECB working paper. I encourage you to read it, but that paper has been applied on a different research question. In our case, we have this model, this quantile VAR model that has been applied on a set of variables. The only exogenous variable is the geopolitical risk, and there is a list of 6 endogenous variables. That is the keys, is a measure of realized systemic stress in the financial markets. Then there is, we also have as second in our list the economic policy uncertainty, which is used here in order to control for different sources of risk. So in a sense, we have more like an impact of military types of geopolitical risk in our study. Third variable is the SRI, which is a measure of the systemic risk built up in the form, for instance, of excess credit developments. And fourth variable, inflation. Fifth, the real GDP growth. And we also have a variable for the monetary policy. Why the QVAR? You will see it is because unlike traditional VAR models, the QVAR allows you to have a conditional estimate of the entire distribution, okay? So not only the conditional mean or median. This is an illustrative analysis that we are doing. We call it illustrative analysis because this is ongoing work. And here I'm showing only the impact on the real GDP growth and on the keys. On the left-hand side, we notice that the impact of this hypothetical shock is minus 1.2 percentage points for the 1 year had euro area year-on-year real GDP growth. And this estimate is actually in line with projections related to the Russian invasion of Ukraine, for instance, produced by the European condition, because you can calculate it by doing a subtraction of the estimates right before the Russian invasion from the estimates right after the invasion. This is, of course, a back of the envelope sanity check, let's say, of the analysis that we are doing. Second point, it's the impact on the keys. And we notice a significant amplification of the level of the keys, this systemic stress in the financial markets, and also the dispersion. So again, this is something that the QVAR allows you to do. So I encourage you to read the paper by the ECB colleagues. And third point, so we have seen this impact on aggregates in the euro area. We try to go beyond aggregate effects. And here it's important to understand what is the type of analysis that we want to do. So for instance, we want to understand whether the economy of a European Union country is exposed to shocks originating from another European Union country like France or a non-European Union country like China. And while, of course, the Caldara-Iacovello is a fantastic index, sometimes, for instance, in our setting, we felt it's better to use a different type of identification because, for instance, here you may notice that the Chinese Caldara-Iacovello index is similar to France, but of course we can understand that the trade and financial linkages between this hypothetical European Union country with France are to be assumed as being less concerning and less abrupt to be moved compared to the trade and financial linkages with China. And I mean, for instance, here the anecdotal evidence is the spat between Lithuania and China in late 2021. So we can see that sometimes you have these rapid movements. And using the same approach that has been proposed in the latter part of the previous presentation, we use the voting patterns of the UN, and we defined a set of geopolitically distant countries based on the quantified distance in the voting patterns. And you can notice in the you can see the list of geopolitically distant countries in the map here. And we also defined the borders of the European Union because it is the area, the reference area here. Although we also study the exposure to geopolitically distant countries of the US and other countries. And with this chart on the left, you can see two main dimensions. First of all, the FDI with geopolitically distant countries in percent of GDP, and also the trade in goods and services with geopolitically distant countries. And we decided to summarize it in a geopolitical risk scoreboard. And you can notice that Baltic countries and some countries that tend to have higher FDI tend to rank higher in this scoreboard. Unfortunately, we have to say that many of these countries with relatively higher geopolitical risk score, they tend to have lower debt to GDP, which means that they can have more fiscal space to address potential defense spending or different types of shocks. Conclusions, very briefly. So we have shown that financial markets may be underpricing the tail risks represented by geopolitical developments. Second, there is no single universally applicable measure of geopolitical risk. This depends on the objective of the analysis. Quantal-VAR suggests that there is a significant potential impact from shocks on the economic and financial stability, and also we have provided this scoreboard of the exposure to geopolitical distant countries. Thanks a lot.
Many thanks, Raffaele, for, again, another compact presentation, which leaves, I think, enough time for the last presenter, Galip Kemalozan, who will be speaking about international trade and macroeconomic dynamics with sanction. Please.
Yes, thank you for having me. So I'm the only non-Italian speaker in the panel, but I have an Italian co-author. So yeah, so this is joint work with Fabio Gironi from the University of Washington, Dai-Soon Kim from North Carolina State University. And the usual disclaimer applies because I have a family to provide. And, and these are our views, not our employers. So it is easy to motivate this paper to this crowd, so let me jump into the questions like right away. So in this project, we basically ask, what are the impacts of trade and financial sanctions, both in the short and long term? And who's more affected? Like the question is whether the sanctioned economy gets more affected from the sanctions or the sanctioned economies gets affected. And we look at the responses of international balances, macro aggregates, and study welfare to understand the economic implications on the sanctioned and sanctioning economies. Third, what is the exchange rate response? We also track the responses of relative prices across the border and try to understand whether sanctions effects are related with the exchange rate response or not. In order to provide answers to these questions, we develop an asymmetric two-region model of international trade and macro dynamics. This is our starting point. In one of our extensions, we also have a three-country version of the model, and I'm going to also show some results from the three-country version as well. But let me start with this two-country version for pedagogical purposes. In each country, there is an upstream, perfectly competitive gas production sector, and foreign country will have comparative advantage in producing gas vis-a-vis the home economy in our model. There is also a downstream consumption good production, and in this case, home has comparative advantage in production of consumption goods vis-a-vis foreign's capability of production of consumption goods. In this sector, like we have endogenous entry subject to initial sunk cost, And there is some firm heterogeneity with respect to their productivity. Like these sectors, the consumption good production sector will be populated by firms with heterogeneous productivity. And only those who are productive enough will be able to cover their cost associated with exporting and will be able to enter into the export market. So there will be an export cut of productivity in each economy. And international financial markets are incomplete in order to have some interesting aspects for the current account. So our setup is a dynamic general equilibrium setup, which uses the Mellitz trade model as the micro foundation. And Mellitz trade model introduces the heterogeneous firm with firms like with heterogeneous productivity firms that we also introduce in our setup. This is also related with Fabio's work with Mark Mellitz. So we introduced sanctions in this setup. Sanctions put on foreign buy home and designed as forced exits at extensive margin. So we are very serious about modeling sanctions. We think that they are not modeled in intensive margin. They are not tariffs. They are exclusion of certain products and exclusion of certain entities from economic transactions. And we are going to pay attention to that difference. For consumption good trade sanctions, we model them as prohibition of trade of outputs of producers with productivity above a certain threshold. So if I was able to click on that link, I was going to show you the list of items which were subject to sanctions from the European Commission reports, the US reports, and some reports from Canada. And you would see that sanctions are not blanket bans. They are introduced on certain goods, and these are mostly high-tech goods, including luxurious cars, circuit brackets, like microchips, some computer-related items. So these are the products of really high-tech firms. And we introduce sanctions by exclusion of firms who are the most productive in one economy. So on top of the export cutoff that I mentioned in the previous slide, there will be also a sanction cutoff for these firms. And those above a certain productivity will stop exporting their goods to the other region. We also introduce financial sanctions. We do this by introducing heterogeneous households in each region. So a fraction of foreign households is going to be excluded from international bond trading in this case. And we also study gas sanctions by a full stop of gas imports from foreign. In the paper, we have some tractable relationships, how to show the determinants of the gas price and the determinants of the real exchange rate. And then we also show some illustrations, numerical illustrations, to show the impact of sanctions, which I'm going to show in this presentation without showing the tractable relationships. And I'm also going to talk about some international business implications, just to touch on the relevant issues with fragmentation. And I'm going to talk about the results coming from a three-country extension of our model. So first of all, what do we learn? The first message is sanctions hurt the sanctioned economy more in our model. So there is both producer recomposition in the downstream sector, both within the sector, and also there will be reshuffling across the sectors as well, between the energy producing and the consumption good producing. Within the consumption good producing sector, heterogeneous producers reshuffle, and because this consumption goods sector has comparative less advantage vis-a-vis the home economy in foreign, so there will be some resources pushed into this low comparative advantage sector in the foreign economy. And it is all about sanctions creating inefficient resource allocations, both within sector and across sectors. Financial sanctions are more effective only if greater share of foreign is sanctioned, because if those non-sanctioned can borrow from international markets, they can provide hedge to those who are sanctioned. And exchange rate reflects only the producer recomposition and export markets, whether more productive exporters are entering into export market or the export market is left behind to low productivity firms. It is not related whether the sanctions are working or not. Exchange rate can depreciate or appreciate. It doesn't tell anything about the effectiveness of the sanctions, but it only shows the producer recomposition. Another message from our paper is that sanctions still hurt when there is trade diversion to third countries. There are significant welfare losses in the foreign economy, which is subject to the sanctions. If sanctions are targeted towards less efficient sectors, and if the sanctioned economy is enforced to move their resources into the less efficient sector simultaneously. And trade diversion is always costly. When you take trade seriously, even there is possibility to divert to third countries, like there needs to be associated costs in those third countries to enter into export market to cover their export costs. So it is not a perfect substitution. And our international business cycle analysis show that when we compare two equilibria, sanctions equilibrium and no sanction equilibrium, under the sanction equilibrium, of course, the cross-country correlations are changing. So there is some role for fragmentation, which is straightforward to think. But which is not straightforward to think is that they have limited impact on within-country business cycle. We don't see the volatility of GDP changing a lot, at least in our model, after the introduction of sanctions. So instead of showing the model, like pictures speak louder than equations in this case, I would like to show you the architecture of the model. So there are two countries, two regions in this case, and there are gas producers in each country. They are both endowed with some natural gas, denoted by GN in this case, and foreign has comparative advantage by having more gas natural resources. In the upstream sector, this is where the action is taking place. There are heterogeneous firms, each labeled with productivity little z, and this productivity is determined upon entry, when firms enter into production, and only firms above a certain threshold of this productivity are able to export, and this is denoted by ZX. Our model is asymmetric, also for the consumption goods sector across the countries. There will be higher sunk costs of firm entry in foreign, indicating comparative advantage of consumption good production in the home economy. And finally, countries trade non-contingent bonds with each other, so international financial markets are incomplete. And we are going to introduce sanctions to foreign households by excluding some of them from the financial markets. To get into more details about how we introduce sanctions, so you can think about who are operating in the export markets, in the home economy, of those firms with productivity starting from ZX. This is the cutoff productivity for the exporter. So we are going to change the support of the productivity distribution to ZX to ZS, which is the ZS is the sanctioned firm with the minimum productivity. So if a firm has a higher productivity than ZS, they will be excluded. And we don't take stance on why they are excluded. It can be due to government enforcement, or it can be also self-sanctioning as well. Gas trade sanctions, so this is the market clearing condition. On the left-hand side, you see the supply of gas, and on the right-hand side, demand for gas. So there is an indicator function that takes the value 1 when gas sanctions are in place, so home stops importing gas from foreign. And for financial sanctions, we divide the households into two. So these are the budget constraints of sanctioned and non-sanctioned households. The difference is that the non-sanctioned household still has access to international trade of bonds, but the sanctioned household only trades bonds within the country, within the foreign economy. So let me jump to results. So in response to export sanctions, so what we do here is we start from a no-sanction equilibrium. Then in period 1, sanctions are introduced, and we look at the transitional dynamics to the new steady state after the equilibrium switch to the sanction equilibrium. And here the green lines indicate the responses of these aggregates when the equilibrium switches to the case under home export sanctions. So the exercise is here, like the top 5% most productive home exporters drop from the trade. So what we see is that when the most productive exporters drop from trade, the demand for these products are compensated by lower productivity firms in home. And the home export cutoff, the first row, third column, the little figure, you see that home export cutoff goes down, indicating that lower productivity firms are entering into export market. If lower productivity firms are exporting, these are low productivity firms, so their prices are higher. If the home export price is higher, then real exchange rate depreciates from the home perspective. And there is rebalancing in foreign towards consumption goods sector because they cannot import consumption goods from home. They are moving their resources to their less efficient consumption goods sector in order to produce the consumption goods rather than buying from abroad. And there is factor input demands increasing in foreign, including the labor, as we see from the figure in the second row, second column. And entry of firms are increasing in foreign. Now let me show you the response to import sanctions, which is denoted by blue lines here. Again, the exercise is the top 5% most productive foreign exporters this time, drop from the trade. So the foreign export, the most productive exporters are dropping from trade. They are being replaced by lower productivity firms in foreign. Foreign export cutoff goes down. And because it is populated by lower productivity firms, this time foreign export price increases. And the increase in foreign export price is being reflected as appreciation of real exchange rate from the home perspective this time. If you look at the responses of consumption, in response to both export and import sanctions, the consumption in both regions go down. But if you look at the exchange rate response, it is going into the opposite directions. So exchange rate is not telling whether sanctions are working or not. So let me talk about welfare. And when we extend our model to three-country setup, here we have a home country, foreign country, and the rest of the world. And again, home imposes sanctions on foreign. And we are looking at what happens when the rest of the world joins sanctions or does not join home economy to impose sanctions on foreign. First of all, in every case, the effects of sanctions on foreign is higher than the effects of sanctions on home economy. And when the rest of the world economy joins sanctions, the negative effect on the home, of course, decreases. But it is coming at an expense for the rest of the world economy in terms of welfare losses. When they join sanctioning the foreign, there is an increase in welfare losses. And it also opens the question like what kind of dialogue should be introduced with the rest of the world to introduce sanctions that has higher economic impact on foreign. And in the welfare analysis, we also see that the consumption good trade sanctions generate the most welfare losses in foreign. And it is because consumption good trade sanctions simultaneously sanctioning the least effective sector in foreign because they have low comparative advantage, remember? And they are forcing the foreign economy to move the resources into their low comparative advantage sector simultaneously, creating the most inefficient resource allocation. Here, I would like to show you the implications of international business cycles. So here, this figure shows the volatility of home GDP and the co-movement of home GDP with foreign GDP in the second row. The red lines are from our benchmark scenario without sanctions, and the dashed blue is benchmark under sanctions. But the lines with the circle inside is what if we remove the comparative advantage, like if they were symmetric countries rather than home having comparative advantage in production, consumption goods vis-a-vis foreign. We see that the volatility of home GDP does not change a lot. And here the horizontal axis is with respect to different parameterization. So we check the results like for a set of parameters as well. And we see that the difference between blue line and the red line in the first row is very small, telling that under the sanction equilibrium, the volatility of GDP in home doesn't change that much because more or less by moving the resources into another sector, like they can compensate some of the impacts of sanctions. But the cross-country co-movement gets, there is a huge impact on cross-country movement, also indicating the fragmentation when sanctions are introduced. So to conclude, like sanctions hurt the sanctioned economy more, and there is reallocation of resources in the sanctioned economy. When there are sanctions of final good export and gas sanctions, the resources are moved towards final goods production in the sanctioned economy. And when there are import sanctions, the resources are moved toward gas production. Financial sanctions are more effective if greater share of foreign is sanctioned because those who are non-sanctioned like can provide the hedge to sanctioned households. And exchange rate reflects only the producer recomposition and export markets rather than showing whether sanctions are working or not. Sanctions still hurt when there is trade diversion to third countries, and there are significant welfare losses in the sanctioned economy if the rest of the world joins. But even if they do not join, like this Milton Friedman argument, if you look at the 1980s opinion editorials, for example, when there were sanctions against Soviet Union, Milton Friedman was arguing that don't do this, you are creating inefficiency in your own country, and there is always perfect substitution. But when you take trade more seriously, there is no direct substitution, and there are costs associated with substitution, which makes sanctions still work. Thank you.
Many thanks. All the speakers have been quite disciplined, I should say. So we have about half an hour of possible questions. Perhaps just to break the ice, I would have two questions, if I may. One for Enrico. I think I was not the only one, since here we are in Luxembourg, in Europe, to note the particularly strong apparent vulnerability of European emerging markets to risk. So whether he could elaborate on that. In particular, a question I had was that in one of the first slides, we saw there was a very big spike related to the war in Ukraine. So to which extent his specification is able to disentangle the effect of this particular episode to the fact of belonging to this group? Because this was kind of a counterintuitive, at least from my relative to my priors, because these countries, some are part of the euro area, all are part of the EU, so they should enjoy some kind of safety net. And the question, perhaps it is more politically oriented, I would have for the last presentation. I think possibly I was not only one intuitively to think of a three-player game with the West, Russia, and China. If we can still speak of the West, but okay, that's another matter. So there is a widespread perception that indeed the fact that Russia was able to source many products from efficient producer in China greatly reduced the impact of sanction. So whether, I understand it is quite politically orientated, but whether the model can shed light on this question. Perhaps you can begin to answer, and then we see if there are questions, hopefully to collect.
No, sure. So that's a very fair question. I mean, we are still running some robustness analysis on our results to check exactly this kind of thing that you're pointing out. So I think what is happening there is that, I mean, we have these results of these geographic results. So there is like emerging Europe, and then there is this other result, which is the size of the shock matters, the size of geopolitical risk matters. And of course, in our limited samples, these kind of two concepts, sometimes they overlap. And I think this is what explains our results, because if you think about emerging Europe, is also the one that experienced the highest shock, right? So we're seeing big increases in Poland, big increases in Romania, big increases in Hungary in terms of geopolitical risk. We did the exercise of removing Ukraine and Russia from the sample of emerging Europe to see if we still get the result of emerging Europe being very sensitive to geopolitical risk, because we were a bit concerned that it was all driven by this Russia-Ukraine war, and we still get the result. But then again, I think it's a bit because this region is a bit overrepresented in our sample. So you nailed a weakness of the of the paper right away. Well done.
Yeah, regarding your question, so this uses the Melitz trade model, as the micro foundation. So it is all about within sector, and because of our setup as two separate sectors, this is a reallocation between those two sectors. Actually, we have a paper, a subsequent paper, which uses this framework to generate some quantitative results from a three-country model, which is calibrated to Russia as the sanctioned, EU, UK, US for the West, and India, China, Turkey for the rest of the world, which is written before I joined the fund. And so it is published, and the issue is, like, when there is possibility to substitute towards third countries, like, these countries are already conducting trade with the sanctioned economy, and there should be some additional demand for their exports. And this additional demand should be coming from new products, so creation of new products in these third countries. And these new products getting into export market is costly in this trade micro foundation, and this is what creates the imperfect substitution. I have a question for Enrico, actually. If I may.
Go ahead.
Okay. So you are using Dario and Matteo's index, like, which is using English-based news.
Yeah.
So there is a paper in Journal of International Economics recently published, I think, uses news based in Russia.
Yeah.
And they show that the spikes are different when they compare with the English news and the Russian news. So the perception changes. Did you consider, like, how these portfolio allocations depending on perception?
Yeah, of course we considered it. We consider it quite a lot, and that's actually the reason why we focus on Anglophone and Anglophone funds and funds based in Luxembourg, because exactly we know that measures of geopolitical risk based on news, they change dramatically depending on the sources that you're using. So if you construct the geopolitical risk index using Russian newspaper or Chinese newspaper, you get completely different thing, right? So we want to focus on Anglophone funds in the end, because we choose the subsample of funds that live either in an English-speaking country or in Luxembourg. And the reason why we think Luxembourg asset manager, they still read English news is that this is like a big hub for investment funds, and so we hope they read the FT here in Luxembourg, and I'm sure they do.
Question, there is one there.
Thank you. This is another one for Enrico. Have you thought, I'm sure you have, but of extending the data to cover the last 3 months? Because safety is relative, and if we're talking about being able to reallocate funds from riskier areas to less risky areas, then what should we expect should happen with the safe haven becoming actually one of the riskiest politically among the G7?
I love this question. do we want to collect the other question? Or?
Yeah, there is a next and another behind. Perhaps we can collect 3 questions.
A bit going in the same direction as my colleague here, Ermal. I was wondering if you, because you have funds in Luxembourg and in the US, I understand, and maybe the UK as well, do you see any difference in behavior that these funds have? Because as you were also saying yourself, the perception of risk is relative and depends on where you are based. So I was wondering if there's any difference between the European funds and the ones that are based across the Atlantic, for example, in terms of behavior that you see. And the second question is, have you seen any difference in behavior, or what are your views on this? Because if there's an extreme spike in geopolitical risk, many people want to react to that, and lots of people will be going in the same direction. And in these kind of situations, there might be an issue of liquidity, that you are not able to unwind your positions even if you would like to. Do you see that investors then take other measures, countermeasures, for example? Do they try to hedge more, or do they try to unwind other assets that might be correlated with the assets that they are trying to unwind? So, for example, I'll take the example of myself. I'm Dutch-Polish. Suppose I would be trying to unwind Polish assets, unfortunately, but I cannot do that. Am I going to try to unwind Dutch assets? Maybe not. But as an example, what are your views on this? Have you seen something on this in the data?
Good afternoon, and thank you very much for all the presentations. My question is also related to the paper of Enrico. And you mentioned the fact that the geopolitical risk perception significantly increased in emerging Europe, countries like Poland, Hungary, and Romania. On the other hand, we had a significant increase of the gross fiscal capital formation in Poland and Romania since the outbreak of the crisis in Ukraine. So how can you explain the gap between the significant increase of the geopolitical risk perception on the one hand, and on the other hand, the strong increase of the gross fiscal capital formation? I'm talking about 2023, for instance, when we had annual growth basis of gross fiscal capital formation of 12.6% in Poland and 14.5% in Romania. Thank you very much.
All right. So so let's begin with the quicker replies. So this question about liquidity, what role does it play? I mean, it's a good comment. We're going to try to incorporate it, maybe adding some liquidity control in our regression. We don't see much, honestly. So we haven't we haven't looked at this dimension so much, but it's a good comment. One thing I want to mention, though, is that in the database we see the country allocations, but we don't see the asset allocation. So we have the split bond and the equity, and then we only focus on bonds. So the ideal test for liquidity would be to check an asset of the same country with different liquidity with different liquidity properties, and this unfortunately we cannot do. We could do it with SHS data, which is available at the ECB. We have gained access to that database, but it's going to take us a while to answer that question. On the question again on the difference between the US and the UK and the Canada and the other English-speaking countries that are not the US, we didn't exploit this dimension yet. I mean, it's true that there are different news outlets in the US and in Europe, but I mean, the kind of information we were getting until like a couple of months ago in the US and Europe was very similar. So I don't expect much from that dimension, but it's very cheap for us to look into it, and so we can definitely do it. For the gross fixed capital formation of 12.6% in this big country, so here we're looking at portfolio flows and we're looking at bonds. So I don't know if what you have in mind is more like equity flows and maybe also FDIs. So maybe we are just not looking at the same measure in some sense. So I see you want to reiterate on the point, so I'm...
Because the geopolitical risk perception increased significantly, this is true. But on the other hand, fixed investments in the economy also increased.
Yeah, no, I see your point. I mean, probably we're looking at different different series, because this is what we see when we look at bond flows. Yeah. Yeah, but the portfolio movements that we see are real. So the geopolitical risk index is a perception, but the portfolio changes that we observe are real. So these are real reallocation of resources from one country to the other. So I find actually very interesting what you're saying, that essentially we capture probably a part of the international capital flows, which is not fully representative of the entire balance of payment or capital account of this country. I guess this maybe this actually reconciles what you're saying with what we find.
Explanation is that from the geopolitical point of view, the outbreak of the crisis in Ukraine determined a significant focus on the countries in Central and Eastern Europe because they are the eastern border of the NATO. Everybody wants to avoid the spread of the geopolitical risk perception from emerging Europe to the core Europe. So actually what happened, we had an increase of the risk perception, but in reality, in the real economy, we had a significant increase of the fixed investments.
No, I see what you mean, but I find it interesting that we see actually the portfolio investment actually declining. So we probably need to go deeper into the countries that you are mentioning, so the one really close to Ukraine and so on, to see if we see the results that you are suggesting, and then we need to understand why our data, they say something different than the aggregated data. And then there was the final comment, which I really liked about what's happening now. I also have sometimes the feeling that this paper has aged a bit already because I mean, of course, I mean, we used to be a place where there was like the US doing like the COP for the entire world. And this, of course, has implication for what we are studying, because of course when you know that there is an agent in the world that guarantees that there is a certain order being preserved, then of course, I mean, the impact of geopolitical risk is going to be smaller because you know that it's not going to propagate globally. But now, since the last 3 weeks, 3 months, we are not anymore in this position. So I don't know how the world is going to look like. We have the data, we haven't analyzed them, but my gut feeling is that shocks are going to be magnified because you know there is not anymore the global COP that is going to enforce rationality in the world, and so every shock is going to be much less predictable. So that's a very fair point.
Are there questions from? Yes, one.
Hello, thank you very much for your presentations today. Well, actually, I am a digital transformation expert, and I was wondering, well, how are emerging technologies, including AI, quantum computing, or digital infrastructure, are actually being considered or being factored into the EU-level risk frameworks? Would you see this as a very good potential for Europe to actually build more sovereignty when it comes to its economic policies, I mean, using the emerging technologies as a strategy for having more, I mean, this kind of entanglement that we're having with the US to have a different form. And these external sanctions, which are actually also causing discrepancies when it comes to actually implementing these emerging technologies in the region of Europe, and especially in Southeast or the Balkan. I mean, economies, emerging economies at the same time. So I would really appreciate an answer.
May I say something?
Yeah, please.
So I think that that's an important part of the equation, and I encourage you to read some publication from the ECB, particularly the SSM is producing really interesting data on the outsourcing services by the SSM banks, and I encourage you to Google it, and you can see the size of the dependency on non-European Union countries, and the first 5 largest providers of these services are not from the European Union. So I think that that's something that we have to reflect about, and certainly I don't have any answer, but I think that it's important to be documented in this area. Yeah. And there is also interesting data coming from SSM.
Right.
Yeah, I'm not an AI expert, but with regards to technological impact of sanctions, like from our setup, and for example, we see that high technology firms are stopping sending their goods to Russia, and we also see in the newspapers that, for example, Russian planes are getting on fire more easily. Maybe they are substituted by some other products, like which are not at the same quality level, like which might have significant impact.
Good. No? So perhaps we can, perhaps if you allow me to very small point. I mean, the question on the United States, I guess, was a bit on everybody's mind. I think you made a rather obvious point in terms of global risk. Perhaps a more specific question, whether would you expect the safe haven effect that you highlighted? You know, that when there is a higher perception of global risk, actually there is a flow into the United States to persist. And then without re-entering the discussion on, say, financial portfolio flows and investment, just being a since public finance accounting is a bit one of my cup of tea, I could not resist noting that since the ESA 2010 system entering into account, military platforms are part of gross fixed capital investment. So part of, at least of the surge of investment in, say, Poland, reflects purchases of tanks, fighter jets, and the like. So I could not quantify, but I think this should be borne in mind. So this is not really perhaps productive investment, although Barro is on record saying that military expenditure is the most productive expenditure because it protects the way of life of the United States.
Okay, so about the safe haven. So, I mean, it's hard for me, in some sense, to speculate on data I haven't analyzed, right? So, I mean, we have the data, we need to see what the data tells us. My feeling as someone who has also lived on the other side of the Atlantic for a while is that the financial sector in the US is so big and so central to the global financial infrastructure that this safe haven status of the US might disappear, but it's not going to disappear overnight. So there are good reasons why capital flows to the US fees are lower. Financial sector is much deeper. Returns are higher than in Europe on average. So I mean, these factors are not going to disappear overnight. That being said. Also not to mention that financial wealth is mostly American. So I mean, American investors, they are probably like they represent a large portion of global wealth. So these factors are going to stay there. But of course, I mean, these geopolitical risk, but is more broadly maybe this unpredictability of the investment environment that we see now is gonna affect capital flows at some point, especially if it's protracted.
Thank you. So I think we can draw this session to a close. I thank you very much, all the participants and the public for their questions. So we have. So we are on time. I leave the introduction.
Yeah, probably I speak on I move it a little bit forward.
Ladies and gentlemen, it is now my great privilege to introduce Markus Brunnermeier for his keynote lecture. I'm also jumping in today for somebody else who couldn't make it here. My name is Ernest Kram from SUERF. Markus Brunnermeier is the Edward Sanford Professor in the Economics Department at Princeton University and Director of Princeton's Bentham Center for Finance. His research focuses, I guess all of you know, is on international financial markets, the macroeconomy with special emphasis on bubbles, liquidity, financial and monetary and price stability, and digital money. Markus is the author of countless scientific articles in top economic journals. He's widely known and recognized for his top-of-the-line Markus Academy, really best in class, I could say, a series of webinars. And he's the co-author or author of several outstanding and widely recognized and read books. Now, this is where today's event comes in. Among Markus's important books, there is one which is particularly relevant for this conference, It's called The Resilient Society and was published in 2021. And it's no secret that I'm a big fan of this book. And therefore, this is already the third time that Marcus speaks at a SUERF event on some aspect of this book. Now, there are three interpretations to this series of lectures on your book. First one is we have a subscription at SUERF. The second one is we are extreme fans of your books and of your research. And the third is the book and its underlying ideas have universal value and are growing in importance every day. Now, unfortunately, I have to say A does not apply. We don't have a subscription, but B and C do apply. Without further ado, Marcus, may I hand over to you for your take on how Europe might achieve resilience in a shifting global order. Thank you.
Let me just get the clicker. Okay, thanks a lot. It's a pleasure and honor to present here, and I hope I can live up to the high expectations which would be put forward. I will talk a little bit about resilience also in the context of the shifting global order and touch on finance and trade issues a little bit. So, of course, geoeconomics is everywhere in resilience. So we have economic statecraft where the government and the states actually dominate the economy much more than before. We don't have everything market-driven. Now it's much more driven by sanctions, foreign aid, investments, and so forth. And so you can view this from an offensive thing, so you can be very powerful to project your power on others. You can also see it much more from a defensive measure, that you actually want to protect yourself, you want to protect your own resilience. You want to be resilient because you get attacks from others. And in general, you might always incorporate with other countries, and there might be not just a cooperation, but also a competition element to it, and in general, there's a co-opetition element to that. So when you think about the geopolitical shifts, more generally going back a little bit, there's one, I would say, one is in the technology space, which is much more the increasing returns to scale phenomena is much more important going forward. So the market size matters. So we have seen this over the last decades. Just think of software that fixed costs are very high, the marginal costs are very low. Essentially, you have huge economies of scales, and especially when you switch to new technologies from combustion engine to an electric engine, it's always up front. You have huge fixed costs. The market size really matters, gives you a big advantage. And the first answer we had to this in the last few decades, let's have globalization. Everybody can specialize what's real, what they're good at, but then has a global market essentially to exploit these economies of scale. But we live in a shifting world order where instead of having a multilateral arrangement, we move to a much more bilateral bargaining arrangement. And instead of having rule-based, we have essentially the transactional-based global order coming up. So these are huge political shifts. And what does it mean? It means first that small countries will hurt the most. Okay, so you have to be in a big bloc in order to represent your interest. If you're a small country outside of a bloc, and the bloc is not bargained for you, you will actually have much less influence. And even within, let's say, the European Union, it will probably be the case that everybody will recognize how important the bloc is. So to run wild within your bloc might be more costly going forward. So if you're a small country, you better be careful. So that is one thing. And so you will also see that there will be a shift towards the large emerging economies as well, India, China, and so forth, while smaller emerging economies, they will suffer from this new world order. So let me go a little bit to, what was the world order characterized beforehand. It was very much characterized by mutual interdependencies. And essentially, the way you can think about this, we actually made us deliberately not resilient. So we tried to be non-resilient because we made each other dependent on each other. And this way we said, we won't fight a war against each other because we would hurt ourselves. So let's be a little bit non-resilient to ensure peace and ensure some international stability. And this is with respect to the finance arrangement, with respect to trade, Within finance, I will talk in a minute about the dollar and the US Treasury played a particular role. We had the swap line arrangement from the Fed spreading, creating some dollar influence and so forth. And some form of resilience was built by having some large reserve holdings. But there was a so-called a balance of financial terror, Larry Summers called this. We have some control over the others have the control over us, and so forth. And there is some everything interlocking of the system. In terms of trade, it was the case that we had just in time instead. We were very dependent that everything is delivered on time with the global value chain, so we were very dependent on each other. And we had certain choke points. And I will talk about the choke points much more in detail. What are choke points in trade, which others had threats over us and we had threats to them. And we had so many choke points all over the place that it doesn't really matter whether you have 100 choke points and I have 50 choke points. Essentially, there's enough choke points that we can just rely on a multilateral global system. Now we were switching away from that, where we say, now we have to be resilient on our own. Everybody has to be resilient on his own, and hence we don't need essentially a global mutual system which is resilient, the global system. So it's much more, everybody wants to be resilient on its own. In finance, it means we have much more reserve holdings. Whether we want to hold the reserves in US dollars, in US treasuries, is a different question. But instead of having just in time, we have just in case in international trade. Much more autarky, much more self-reliance, minimize choke points, don't expose yourself, be self-reliant in a sense. And that's what I refer to this global resilience paradox. Typically, the global system as the whole multilateral global system was very resilient in a sense that everybody was contributing it, everybody felt to be part of it, and the choke points helped to stabilize the system, while now everybody wants to be locally resilient, and that destroys the global system because the global safety and global resilience is a common good. Everybody has to invest in it, and nobody wants to invest in it. Everybody withdraws to the national resilience, and essentially the national resilience destroys the global resilience. That's what I call this global resilience paradox. Now, we move away potentially, so this is a hypothetical thing, away from a unipolar world to a different world order. Okay? And there's some observers out there who claim if you move away from a unipolar world, you typically move to a 5-polar world. Okay? So there will be 5 poles in this world. So this is a hypothesis. It's highly speculative. Probably the US will still be at the center to a large extent, but we might move away from that. So why do we move to 5 poles? Okay? The argument is, first of all, it has to be an odd number of poles. So any power is pivotal, and if it switches the camp to some extent. And then the question is, why, if it's an odd number, why not 3? And there's an argument that if it's 3, then it's 2 to 1, and if it's always not balanced. If one guy switches, it just destabilizes the whole system. And then you could say, we have more odd numbers. We can also have 7, 9, 11. And then the argument is, no, this can't be, because then the members in each coalition would actually then have too much free riding incentives. Okay, so the only thing which really works is a 5-polar world. And that, Herfried Münkler and others have made this argument this way. It has to be 5. And some historical examples, and I will refer to Harold later on to give you more details, where once you have a unipolar world, like say after the 30 Years' War, at the end of the Habsburg monarchy controlling not only Austria, Hungary, but also Spain and the Benelux to some extent, you move to a 5-polar world. And then there was Austria-Hungary, essentially, then there was Spain, France, England, Sweden, and later Spain was replaced by Russia and Sweden was replaced by Russia. But it was always a 5, essentially, arrangement. And even after the Napoleonic Wars in 1815, it was also, 5 powers in charge: Austria-Hungary, Great Britain, France, Germany / Prussia, and Russia. And of course, and this was a long period of peace, and it was a stable arrangement, stable world order. So the question is, what will the future be? If it's 5 poles, that's highly speculative. The US is, of course, still part of it. China, European Union, India, is it then Russia or is it Japan? I don't know whether it's more the military side or more the economic side. But the thing is, what I want to say, I don't know where we are going, but the transition is a question, how will we make the transition? We might stay in a unipolar world, and how do we make the transition? And the transition, you would like to keep some resilience. So typically, you can think of a world, we have the old global order, so think along this blue line, and we move to a new fragmented global unorder, I don't know, in a sense, or you move to a 5-polar world. Essentially, it's a worse arrangement compared to what we had before. But you don't move slowly down during this transition phase to the new order. There will be a J-curve effect. Essentially, you move actually much further down, and hopefully you come down back to the steady state in the long run. And if everything goes fine this way, then actually that's still okay. But sometimes, this transition might be very fast, and rather than going down like a J-curve, overshooting and coming back, you actually might hit a tipping point, and you move along this dashed line, hitting the tipping point, and then the whole system derails. Now, that's a danger. And the first one, I would say, is resilient. So you have a shock to the system, to a new steady state, and you move to the new steady state. You might actually go under a little bit further, like this J-curve effect, but you come resilient back to the steady state. It's not as good as before, but the second arrangement is non-resilient. You don't come back. And the question is, how can we generate a world where we actually, come back to the new steady state, whatever it may be. It might be 5 poles, or it might be perhaps the US is still a unipolar world, or it might be total chaos. Or the unorder is probably if you hit the tipping point and don't manage it. So with this big picture, I would like to go now a little bit more in the economics territory. We're saying, okay, let's look at global finance more generally, and then I look at global trade more generally, and analyze some certain choke points. How can you think about choke points? What do you look at? What the choke points are? So, but before, let's look at the global finance, and I will make a few comments about the currency, the US dollar, the role of the US dollar in particular, and then about the safe asset or reserve asset, the US Treasury. And we'll then allude to it, okay, what's coming up? Do we need to build some alternatives? And then coming back to some old proposal I made earlier about the European Safe Bond or the SBs, and also for the global emerging markets, some GLOSBs. So if you think about this, so the US dollar is very dominant in the economy. It's dominant in trade invoicing and foreign exchange, and interbank claims and international bonds and FX turnover. How will this change going forward? If you think about that, and then we have, potentially new currency areas evolving, there will be more dominance coming from the US dollars by stable coins. Okay? There will be a lot of coins coming up, and I wouldn't be surprised if Elon Musk will create on X a stable coin very soon, because the US regulatory environment will be very different. There will be a lot of new US dollar stable coins coming out. And to the extent that people use these stable coins, not only in the US, but across the world, this will actually strengthen the role of the US dollar as a currency. So these stable coins, there is probably will be programmable tokens with regard to social networks, X, Meta, all of these networks. And the question, they will be made interoperable to some extent, and there will be the US dominance on the dollar will actually expand. Now, what's the countermeasure? What's the answer of Europe is, of course, the digital euro, CBDC to some extent. And I was told that, there was a lot of hesitation in European Parliament. Now, with the new global environment, it is going. Everybody is on board to get the digital euro as CBDC going. It's much different. It has a different focus. It's very consumer, retail focused. Others, the stable coins can be much more industry focused, platform focused. It's much more consumer focused. Whether it becomes programmable, like connected to all the different social media platforms and all this, that's still in the air. Of course, China has already Alipay and WeChat Pay. They also introduced the digital yuan in certain provinces. Didn't go so well, their CBDC. Maybe some lessons also for the digital euro for that coming on. But the emerging economies, coming back to the stable coins, the US stablecoins, they probably will be threatened, and they will actually build up their own CBDCs just to have, make sure that they keep control of their monetary policy, their monetary sovereignty. Because if they're dollarized, you can put up the interest rate up and down as much as you want. You will not shift, stimulate, heat up or slow down the economy when the economy is overheating, or speed up the economy when the economy has an output gap. Now, in general, so let me come back to, so this is about the currency side. That's all what I want to say on the currency side. What's about, more generally about, creating global finance resilience? And typically, you can also think about it, the flexible exchange rate environment is essentially a way to have some resilience. And, you can, whenever a country, think of the world as a multilateral arrangement, and whenever a country faces a negative shock, the country can devalue and can boost its exports and come back out. It's like a gentleman's agreement across the countries, saying, okay, if something hits, if one of our countries or two of our countries are hit, they can devalue, boost the export, and stimulate the way out again, and then it actually will go again. So this is, temporarily and mutually agreed. And temporary, when there's a temporary shock, you can do that. Now, of course, we can also do some beggar than neighbor. If you say, okay, devalue all the time at the expense of others, then it's not a global reinsurance or resilience-enhancing arrangement. It has to be a gentleman's agreement that you do this only when you face an idiosyncratic shock or a country-specific shock. Then you do this. If you exploit that and do this continuously devalue just to get an advantage over your other countries, then it's not really part of this resilience or insurance scheme, global insurance scheme based on an implicit agreement at a global scale. And the alternative, of course, you can also go for fixed exchange rate, but then you need much more buffers and reserves and all these things, which might also be costly. Okay, so in this sense, that's two ways to get some global finance resilience. But what I want to talk a little bit more is like how the global financial architecture is designed at the moment, and why it is quite fragile and not optimal at all from a resilience perspective. So there's a lot of flight to safety, and we have seen this in the previous talks. So there might be some geopolitical risk or some other risk coming up, and then suddenly everybody worries about risk, and everybody's rushing into safe haven out of the more risky environments. It could also be that the US is just tightening its monetary policy, and everybody's trying to rushing into US treasuries. So there are a lot of cross-border capital flows to safe assets going on, and the US and some other countries enjoy some exorbitant privilege to issue this global safe asset. Okay. So when the risk rises, so typically the US and some other advanced economies, they can actually issue the safe asset at a very low interest rate. There's a global crisis, risk is going up, and then the US can say, oh, we can issue US treasuries at a very low interest rate, at a very high price, and that allows them to run a fiscal stimulus program and overcome the global financial crisis more easily. And so even if the crisis is initiated in the United States and goes out of the United States, it allows them, because the interest rate is low, to stimulate their way out of it. If you're an emerging economy, you face exactly the opposite, because you have this flight to safety out of your government debt. You cannot stimulate the economy. You actually have to go for austerity measures. You have to go for severe austerity measures, and that way you run the opposite way. Okay? So in a sense, the problem is essentially that the poor country, when there's a global financial crisis, the current global financial architecture is set up in a way that the poor country is essentially insuring the rich. Okay, so typically we would think if a social planner were to set this whole system up for the world, he would say the rich should insure the poor. But the way the flight to safety capital flows work, it's actually the poor insure the rich. Okay, whenever there's a crisis, there will be then, it will be much easier for the rich to, or the advanced economies, to overcome the crisis. And the source of the problem of this setup is that the supply of the safe asset, there's no shortage of safe assets. You know, the US has issued trillions of new treasuries in the last 10 years. I don't think there's any shortage. Many people talk about shortage. The problem is that the supply of the safe asset is asymmetric. It's provided by some countries and not by other countries. And the question is, how can we set this up in a more symmetric way? So here, again, here's the picture. So whenever there's risk on and risk off shifts, and there's suddenly everybody, was worried about risk, so everybody wants to get rid of the risk, there's this flight to safety. And the problem is that the safe asset is not symmetrically supplied, it's asymmetrically supplied by few countries, and it's not symmetrically distributed. You might argue they have earned this right, but it leads to a system which makes the whole system much more volatile and less resilient. It might even hurt the advanced economies ultimately. And so that's essentially this paradox: the poor insure the rich. Now, in order to understand this, I want to go a little bit deeper. What is actually a safe asset? And how can you think about a safe asset and why there is this flight to safety? Okay, and I want to explain to you what these things are. And if you take one thing away about what's a safe asset, just think about it. A safe asset is like a good friend. A friend in need is a friend indeed. So when you're ever in a crisis, your friend is there. And a friend who is not there when you're in a crisis is not really a good friend. So that's what I think of a safe asset as a good friend. If you can issue the safe asset, and if you hold a safe asset, you have it something. So what does it mean? If whenever you're in a crisis, you can sell off this asset at a good price. Okay, it will not tank when you have individually a crisis, but it's also the case that when the whole world is in a crisis, it also appreciates in value. Okay, typically. Okay, so whenever for your personal needs or for your country needs, for idiosyncratic risk reasons, you can actually sell it at a high price, at a low bid-ask spread. And whenever there's a crisis time, it is also maintaining its value, might even gain in value. Okay, it has, in finance world, it has a negative cap M beta. Okay. And often it is also the case that if you're the issue of the safe asset, because it has this nice feature, it appreciates in bad times, it has typically, because it's negative beta, it gives you you have to pay, you get a very low interest rate if you hold it, and if you issue it, you have to pay, you have the privilege that you only have to pay a very low interest rate. Now, there's a traditional asset pricing setting. You think, the price of an asset is just the present value of the future cash flows. Okay, that's a traditional asset pricing world. But what I would argue is essentially the asset pricing world should be extended that an asset also has a service flow. Okay, it's not just the cash flows you get from assets, the interest payments or whatever, dividends. It's also a service. It provides some other services. Okay, the present value of future services. So let me explain to you what I mean by this service flow. It's a little bit more subtle, but let's just assume I take an asset, a bond which pays 0 interest. Okay, so the value in traditional asset pricing would be 0. Okay, can it be that it actually has a positive value? So just to show this, if you think about a government bond, what all bondholders get together is the primary surplus of the government. Primary surplus means, if they don't make a deficit, they make a surplus, so they're paying back the debt, and then essentially you pay to the bondholders some money back, and that's what the bondholders get. So here's a very simple example. There are only two types of people, A and B. Let's call it Alan and Beth. And there's a safe asset which pays 0 cash flow. That's why there's the 0 in these white boxes. And then there's another asset. It's a cash flow asset. It has positive cash flows. These are blue boxes. And A and B have these portfolios. They have some of the safe asset. You don't know yet why it's safe. I will tell you in a minute. But it has no cash flow. Okay? Normally, you would think it should have 0 value. Okay? But it has. I will tell you in a minute why it has positive value. Then we live in a world where we can actually, A and B cannot really insure themselves. They cannot write contracts to each other. There are financial frictions. We live in a world with financial frictions. So in a world when there's a shock, where they move along the upward black arrow, then it will be the case that A's cash flow asset expands, has a positive shock, and B's cash flow asset has a negative shock. Okay? And if the world moves down along the black arrow down, it's the opposite. So ideally, A and B, they have opposing shocks to each other. They would be ideal to insure each other. Okay? but because of financial frictions, they cannot do that. Now the question is, can they do something else? There's this financial friction. They can say, oh, what we do is we just retrade our assets. Okay, so when the world moves up, A gives some of this positive cash flow asset to B, and B gives some of this zero cash flow asset, the safe asset, to A. And when the world moves down, they're trading the opposite direction. So through retrading, they cannot ex ante write a contract, but they both can hold this portfolio and say, okay, when the world moves in this direction, we do some retrading, and this way they can insure each other. Okay? So they can overcome this financial friction. So this safe asset, which allows this retrading, whenever I face a negative shock, I can actually use the zero cash flow asset to buy some positive cash flow asset. We can actually insure each other. Okay? So you see that the benefit you get from holding the safe asset is not in terms of cash flows, it's in terms that you can actually retrade it for some other things. Okay? And you can overcome the financial friction in the marketplace or wherever this friction is, you can use that. So if the government issues now some treasuries or some government bonds with zero cash flows, you would say, I'd still like to have this. So both A and B would say, I would like to have this asset because it allows us to insure each other in the next period. Okay. And that's essentially what a safe asset, it gives you the service flow of overcoming these financial frictions, of insuring each other, even though the market itself cannot do it because of financial frictions. Now, this has some value. No? You attach some value to that. You say, oh, we can insure each other. We attach a value to this insurance component, and that's a service flow, and that's part of the asset pricing, and it increases the value of the asset. Okay. Now, this says whenever we face idiosyncratic shock, we like that feature, so we are willing to pay something. The next thing is, if we move into some world where the risk is actually even more dramatic, this idiosyncratic risk is more dramatic, like I depict here with these black arrows, now it becomes more dramatic, the risk, you would value even more this component. No? So when you go in a very risky world, this is extremely good for that. You would value it more. So the asset value of this price goes up in very risky circumstances. Okay? So not only does it have baseline value all the time, that's a benefit you have all the time, in a risky world the benefit is even bigger. So if you move from a low-risk environment to a high-risk environment, you say, oh, that's actually a fantastic thing. It actually gains value in risky environments. That's where this negative beta comes from. In bad times, it becomes more valuable. That's why the US Treasury in bad times appreciates in value. Okay. And if you're able to issue this asset, that's your exorbitant privilege. Not only do you have a baseline exorbitant privilege, it is also the case that this exorbitant privilege is much more dramatic in crisis times. Now, that's okay. So that's what a safe asset is. And it's good to have this safe asset. So it is in the economy. So now if the US Treasury were to implode, that actually would not be good, no? Because we like this US Treasury. It underlines a lot of insurances, and through retrading, there's a lot of tradings going on. It's for precautionary reasons, we hold it and retrade it subsequently. It overcomes a lot of financial frictions. Now, if suddenly US Treasuries were to collapse, everybody would be worse off. Okay? So, but it still has this feature in a multi-country world or in a global environment that, you know, when the risk goes up, there's then a shift, the benefit shifts to the United States or also to Germany to some extent, also the liquid assets which they can provide, the safe assets they can provide. Now you can say, okay, what do I do in such a world where there's this asymmetry given, and the asymmetry is even bigger in times of crisis because of this flight to safety? I can say in a unipolar world, what I can do is I can just, you know, the emerging economies, the other economies, they can just have precautionary savings. There's, of course, multilateral organizations like the fund, the IMF, with liquidity line, and then as liquidity lines. And then there's all central bank swap line arrangements. And then, of course, within Europe, there's also the ESM doing this same thing. So there's the official sector. And, but the question is, but if we move to a multipolar world, what we do then? if something goes wrong with the US Treasury, we don't know, hopefully not, but who knows, what do we do then? Do we need potential alternatives to the US Treasury? Okay. And can the Europeans provide some alternatives? Okay. And I'm not thinking about the next generation EU fund bonds, because this is a one-time bond that will expire, I checked it in 2030. That's not, and it's not a big enough market in a sense to replace the US Treasury. And then the question is, what do we set up? Do we want to offer an alternative to the world, to provide an alternative safe asset? And it might be even a chance for the Europeans to get part of this exorbitant privilege at the European level. Okay. And the alternative is also, a second alternative is perhaps the emerging economies want to create something on their own. Okay. And can they do that? So this leads me to this SPs, or what the Commission, when we talked about this during the Euro crisis at length, and the Commission was very close to introduce it, and I call it, instead of SPs, they call it SPPS, but you can still pronounce it SPs if you just read it differently. But the idea was at that time to create a pole. So one of the, the European Union will be one of these 5 poles potentially. And of course you can say, oh, we hold the West up, and perhaps with India we work together, but I don't know whether there will be other poles working together so closely. But you create a deep and liquid safe asset market. And how do you do it? You essentially create a pool of EU sovereign bonds, will be bought at the fair price, so there's no benefit, there is not one country benefiting from the other country. If you don't do a good fiscal behavior, you don't get a better deal from this. And then you issue a senior bond and a junior bond. There's some tranching involved in it. So whenever there's a potential crisis of losses in the pool of sovereign bonds by one bond, let's say, or a particular country, then the junior bond will absorb this risk, and the senior bond is protected by the junior bond. Okay, the senior bond is then very, very, very safe, and there's no default risk in the senior bond. And so this way, Europe can also create a large, safe asset, and can to some extent compete with U.S. Treasury, just in case if something were to go wrong with the U.S. Treasury. And then the question is, perhaps the ESM can play some role in this thing. And typically, when this was debated, why did this not work? Because even a private entity could generate such an asset. It did not work initially because the current bank regulation is such that you can hold very risky sovereign debt. You have 0 risk weight on the private bank's balance sheet, okay, by regulation. Sovereign debt has 0 risk weight. It's always considered as risk-free. While if you have the senior bond, which is much, much less risky, you have immediately a huge risk weight on it because it's securitization. Even though it's objectively, it's way less risky than a single bond. Just pooling makes it less risky, and then also tranching makes it even less risky, but you get a much bigger risk weight. Okay? There's something wrong in the regulatory environment which doesn't correspond to any economics, but there has to probably be a European directive to change that. But coming back, the Europeans can enjoy some of this exorbitant privilege, and this by having not only very much US-centric focused unipolar thing, having also the European, it makes the whole world already less asymmetric in the provision of the safe asset. The question is, what will China do? They of course probably want to be benefiting from that too, but of course they don't have open current accounts, so it's much more difficult for them to be active in the national finance place. Now, is there an alternative for the emerging economies to be also participating in that? Of course, they can do this too, and to address the root cause of this flight to safety, to solve this. And they can actually also do the same thing. They can pool their sovereign bonds and tranche them. And the idea is, rather than holding huge amount of reserve assets in form of US treasuries, they can actually issue the senior bond, which is a safe asset, and then investors can hold some of these senior bonds as safe asset as well. And how will this change things? Now, if there is huge risk coming up, then there will be flight to safety still in the US Treasury, also into SPs, let's say in the senior bond. But some of this flight to safety will be in the senior tranche of the emerging economies. And you rechannel this flight to safety from across border capital flows from the global south to the global north. Also, some of it will stay in the global south from a junior bond to a senior bond. Instead of having cross-border capital flows, you have cross-asset class capital flows. Okay? And this way, you have less of this flight to safety capital flows, which are destabilizing the whole global system. So that's essentially what you can do on the international finance side. Of course, we are now in a world, and if you read some of these proposals out there, where there's radical rethinking is on the table. Okay, everything is on the table. Something which we thought will never be thought about. It's crazy. Nothing is crazy anymore. So we have to rethink many things. Okay, let me go to global trade. How am I doing with time? Okay. So global trade is all about, do you want to have choke points or threat points towards the others, and what's about the threat points the others have towards you? Okay. And as I said, in the old world, it was, we had threat points all over the place. We were dependent on each other, and that was the foundation. We really were intertwined, and we could harm each other a lot, but it would immediately backfire and harm us back as well, and that's how it played out. So we have a balance of choke points in this. And of course, we will have then now the global value change we do reshoring only to friends. Janet Yellen made this famous speech saying, we do bring everything back to friends. I don't know what the friends for the US now. So that's, and then there's multi-sourcing. So that's another way. I will come back to this multi-sourcing, how to create more resilience. And you can also just store, of course, this strategic reserves, and you can actually do some resilience management, but just simply storing some important elements. But I would like to go to this choke point analysis, and I want to go some of my thoughts on choke points. Okay, how do you do that with that? I call it choke point analysis 101. So when you think about what's a choke point, you have to think about which products can I easily substitute with other products. Okay, so and this depends on the elasticity of substitutions. If it's an essential product, I cannot substitute with anything else, that's a choke point. Okay? So for firms, I cannot substitute with other input goods, or for consumers, I cannot substitute with other consumption goods. Okay? And of course, you can say the elasticity of substitution, immediately it's very difficult to substitute. Over time, it will be easier and easier because you can suddenly come up with a new production technology, and that might be replacing this choke point or something. There's something intertemporal elasticity as well. So the elasticity of substitution interacts with the intertemporal elasticity as well. It could also be, I cannot replace this product, but as a consumer, I don't mind not having this for 3 months, and I can wait. So there's an interaction between the intertemporal substitution and this elasticity of substitution across products. But the question essentially is, we have essentially whole production chains or whole production network. How should I think about the elasticity of production and of various products, input products, and there's 3 layers and all that. And so I would like to think a little bit more with this diagram here. So here's a production network, a very simple one. There's only inputs, and then there are 4 inputs to an electric vehicle car, and then there's 4 inputs to a diesel car, and so forth. I don't talk about environment. And then these are done different consumption goods, and the consumer at the end consumes it. So there is elasticity of substitutions between all of these products. These are all these epsilons here. And the question is, if the electric car and the diesel car are perfect substitutes for the consumer at the end, so this elasticity of substitution between 1 and 2 is infinity, so they're perfect substitutes, it doesn't really matter at the higher level of the production chain what the elasticity of substitution is. Okay, so the upper epsilons here, there's actually, it doesn't really matter, because what I will do is, if there's some choke point in this E one epsilon A and B, I cannot substitute it. There's a rare earth or something. I cannot really replace it with anything. I can always switch to a diesel car. And if we're perfectly fine switching from electric car to diesel car, I don't care about the elasticity of substitutions at the higher upstream firm level. Okay. On the other hand, if it's not an electric car or diesel car, the first thing is an antibiotics or something, then I cannot substitute it with anything. Okay. So then, if this epsilon 1, 2 is 0, it's Leontief type, so it's I cannot substitute it at all. But then this matters a lot what the upstream epsilons are. Okay. So essentially, what you can say is, as long as at the lower downstream there's elasticity of substitution, I don't have to worry upstream so much. But if downstream there is actually the elasticity of substitution is not there, so I cannot substitute easily, I have to move up and the upstream and have to worry about that. Okay, so for example, that's one example. The other example is it could be that there's one input good which I need for all of these products. Okay, so even in downstream I can easily substitute, but all of these intermediate inputs, they actually need some other more upstream input good, which is necessary for all of them. These are essential inputs. Then I also need to worry about it. So simply looking, it's actually quite complicated to say what is essentially essential good. And when you talk to the official sector, say, "Oh, can you give me a list of essential goods which we have to really worry about?" And I have not seen any think tank who did it. I think it should be done, essentially saying, here's a list of all the essential goods which are potential choke points threatening us. Okay. But that's what you have to look at, the elasticity of substitution. But it's not just looking at the elasticity of substitution. You have to look at the whole chain, and typically you have to look at the downstream products. But this is not, it's even more complicated. You also have to look at upstream, in particular if they enter all of these products subsequently. And this is only for a very simple production network where it always goes in one direction. Okay? But often we have this matrix, the input-output matrices. Something is an output, which then becomes an input for this again, and then it goes back and forth, like a car goes 7 times within the border between Mexico and the United States in the olden days, back and forth. Okay? And so that's essentially, but the short answer is focus more on the downstream elasticity of substitution of the downstream products, except if they're feeding in all of these downstream products. So essentially, where we started out with before we moved in this resilience phenomenon was let's just focus on costs, make everything as efficient from a cost perspective, and we have the increasing returns to scale. We specialize, we have scale through globalization. We put all eggs in one basket, essentially. And then it's, okay, a little bit of risk management we have to do. Risk management means we focus on the correlation. Okay? When you think, how do you manage risk? It's all about correlation coefficients or correlations. And that's what risk management is about. Resilience is different. It goes beyond risk management. It goes, how would you change? You face a shock. How can you bounce back? It's not about the correlation of two things. I face a shock and I can adapt, I can change, and can scale up subsequently. So you essentially, instead of minimizing the risk by diversifying, you navigate risk. There's a shock, you have a setback, and then you navigate, re-optimize, and try to come back. Okay, so it's a navigation of risk. So if you have focused very much on cost efficiency, of course you outsource, you have global value chain and all this. So the opposite is essentially this reshoring, friendshoring. If you go from a risk diversification perspective and you would like to have everything better diversified, multi-sourcing is of course the way. You've outsourced to China, but you also outsource to Vietnam and to somewhere in Africa and somewhere in Latin America. And the less the correlation is across the different continents, the better it is from a risk diversification perspective. Okay. But what does Resilience also means you don't know where the shock will be, but I know I can re-optimize. I have a supplier in each of these continents, and whoever is not hit, I can able to scale up. It's not just sitting there. I have suppliers and can supply me and I diversify across the suppliers. That's also good. But I also have suppliers who can scale up very quickly and provide me more. So when I have something goes wrong in one continent, I can scale up the other continent. So it's not only about the correlation itself that's also important, but also the adjustment I can do. How big are the adjustment costs? So the key variables are the adjustment cost on top of the correlation coefficient from a resilience perspective. Now this is the final slide before I come to the conclusion. Just one thing is when you think about trade tensions, there's of course also globalization and industrial policy, and these two things bite each other. Of course, we moved a little bit away, so with the Inflation Reduction Act, US was doing a lot of industrial policy, and that also distorts a free trade in a sense. And if you think about China, they of course do a lot of industrial policy. How does this square with the globalization or open trade in a sense? And the question is what to do that. And the argument is here that you don't want to throw out the rule book in total to have some trade going on. There has to be a more sophisticated response. So for example, if the Chinese subsidize certain environmental products, solar panels and so forth, you might just say, there's probably, if there's no expertise in it which we can gain from it, we just take the subsidies and say thank you, okay? Because it helps us to make an environment better. But if it's an antibiotic part, if it's a choke point, we might not do that, okay? And then if it's also something where you gain technological advantages in the long run because you innovate along this space, and in the long run you will be, have a huge setback and you cannot make up for it, then there might be future choke points because you didn't keep up with the innovation compared to the other country. And then actually you don't want to do that. So you have to fine-tune then how do you want to deal with this and how do you react to somebody else's industrial policy in this sense. So let me conclude. I think we have a changing world order as we see it. I think resilience is very important. The old world order was, let's have no individual resilience. This makes the whole global system more resilient. So the less resilience we have at the national level, the more incentives we have to have the whole order to be resilient and set it up in a resilient way. And we have a lot of choke points against each other. We are mutually interdependent. And that makes the whole system, in a sense, more stable. Now the focus is much more, each country wants to be resilient on its own, okay, or each bloc. And then we have a bilateral transactional world order where the big countries win, the small countries have no weight, okay? And within big blocs, the smaller countries will have less weight either because they say, I cannot run away from it because I need the big bloc to have any influence. I don't know, we haven't seen it yet, but whether this changes the political dynamics within the European Union or not. But generally, global resilience, to have this multilateral arrangement with global resilience is a common good. People have to invest in it. If people invest more in the national resilience, they have less incentive to invest in the common good or the common resilience of the global order. I argued about global finance. There could be that we move to a multipolar world. I'm not saying it will happen. I just don't want to rule it out anymore. And then the question is, we have anyway, in the global financial architecture right now, we have some asymmetry, and this flight to safety is very destabilizing for the whole global economy. We have to move to a more symmetric provision of the safe asset. And one way is that the Europeans also provide something in form of SPs or SPBS, and the emerging economies in form of CLOSPs in terms of that they do a similar thing at the emerging market level. And then I talked about global trade, about the choke point analysis. This elasticity substitution seems like, that's the way to say that's a choke point, because elasticity substitution, but it's not so simple. If you look at the whole production chain, depends where are you upstream or downstream. if you're upstream, yeah, substitution is not so important, except if you're an input to all the other products which are then downstream, might be even perfect substitutes, then it doesn't help. And yeah, and of course, the substitution could also be that we totally, over time, we might invent totally new production methods. No? So if you have a very innovative, very R&D-driven economy, which can find new ways to do things if they're bottlenecks, then actually you're also less exposed to the whole thing. So let me leave it at that. Thanks a lot.
Thank you, Marcus, for this extremely rich presentation. You said in this new complex world, there are no more crazy ideas. I think you offered a lot of very interesting ideas, not crazy ideas. A very stimulating presentation. So I think we can take 10 minutes for Q&A. Are there any questions? Yes, please. Pablo. Fernand.
Oh, the mic is coming.
Yeah, well, thank you very much, Marcus. Terrific as ever. There is one aspect that you were not mentioning, and sorry because I missed the first 5 minutes probably, which is the risk of entering into a financial deregulation war. And here in Europe, there is already a discussion of what the consequences of moving, in particular on banking, but of course also in non-bank financial intermediation as well, if the US moves to a deregulated environment. I don't know whether you've thought about what the optimal response of Europe should be. I mean, I give you a hint of what I think. I mean, in the end, financial stability is a global public good, and it will be very difficult to move from a steady state on which the interaction is very strong to another one on which interaction is very low. So this means that interaction and the spillovers will remain in the world for a while. So if one jurisdiction that is very important, which is the US, move to a deregulated environment, maybe the optimal reaction of Europe should be even to have higher buffers, because the probability of a financial crisis will be clearly higher. But of course, the conversation in Europe is moving in the opposite direction, as you can imagine, maybe because of the lobby of the financial institutions. So I don't know whether you've thought about it.
So I've thought a little bit about it, but broadly I agree with your assessment that if you have, and it will come in the United States, that there will be less financial regulation, and this will actually. What is also a chance for Europe is saying, okay, we are the safe haven because we have better regulation or more strict regulation. I think this might be also an opportunity in this sense. I don't think it's saying, okay, because the US is regulating less, it's more easy to get a loan in the US. We have to relax it as well just to keep up by providing more loans to the European economy as well. There's an additional dimension to that in terms of, in the US, there's, to some extent, some battle going on between Silicon Valley and Wall Street. So there's a lot of finances moving towards Silicon Valley, in particular in the crypto space or in the stablecoin space. And you could see it during the election campaign that both parties actually were open to open things up for Silicon Valley because they're big donors to both parties. And there will be much less regulation for new stablecoins, for Silicon Valley type of banks, for some, Amazons and other things to move into the banking space. And there will be, of course, I think there will be lobbying from Wall Street banks, but I think at the moment, Silicon Valley has more influence of the current administration. So I see more the deregulation coming by a shift out of traditional banking more to, let's call it Silicon Valley banking and shadow banking and these things. And this will cause some pressure also, on the others and potential spillovers. So of course the SEC under Gary Gensler and all this was very strict with respect to stable coins and all that, and there was a presidential working group on stable coins and all this. They will open this up significantly, and so Europe has to think what's the best response to such an environment, and I think this will be a challenge, but there might be also opportunities there.
Yes, Rolf, please, and then the gentleman in.
Two questions. One is somewhat related to what Pablo said, and more with a view to international currency or the international role of the euro, because you said the US may be strong in stable coins and we may be strong with the digital euro. One of the big question marks is exactly also with the view to the regulation of stable coins, and if it happens that this is relatively deregulated, then there is indeed an issue which in turn implies that there could be a comparative advantage if you have a central bank digital currency, and that could be a point of attraction. There would be one thought that maybe is complementary in this regard. The other question how do you look at this? The other question is, well, if we move towards a five-polar world, the geometry of that may be also creating minimum winning coalitions, right? You try to have alliances of regional blocks that give you the safety that you want, which could be eventually different geometries creating around different issues. How do you look at that and at stability of such a system?
Let me start with the second one. So I'm not a historian, but essentially it's always 3 and 2, and sometimes one block might shift to other one, but that's essentially what we saw in the post-Napoleonic Wars period. I don't know how stable the situation will be, but that's an argument. This might be more stable than having 2 blocks in a sense. But I'm not really the expert on that. The second thing on the stablecoin regulation and the digital euro, I can see, so what happens with stablecoins, I think it will be technologically well connected. So a digital currency is always connected to a ledger. And the question is, can I connect it to some other ledgers as well? So how easily can I connect it? So there will be some industry blocks, industries which will probably have a common platform, create a ledger on it, and any payment will happen on this ledger. So there are a lot of micro payments, and can I connect everything to that? And stable coins probably will be very tightly connected to all these various ledgers, and then they will be more successful. The question is, to what extent can you connect the digital euro to the various ledgers? There might be Siemens trying to have you do a little scan and it will be paid. Every little thing will be paid immediately. Transactions will happen. Can you connect the official CBDC or not to that? Or is it much easier to connect a stablecoin to that, which is designed for that? And these are design issues which have to be thought about. And then the other thing is, if the digital euro is not paying any interest, I can easily outrun the digital euro now. They just offer 1% interest, and the digital euro will not be only in crisis times people will run into it. But otherwise, it's not an attractive competitor to a stablecoin. So then the question is, how will Europe regulate the stablecoin setting? Do you want to keep it with the CBDC, or do you want a separate 2-tier system? There's a CBDC, but as a wholesale CBDC and the stable coins then interconnect with all the various industry ledgers, let's say. Or do you want to have everything run by CBDC? And I don't know where Europe stands on this question. But in the US, there will be no digital dollar. It will be the private sector, private stable coins, and they will be promoting private stable coins. And it will also be the case that it's a bonanza for private firms. Now, they issue a stable coin, they will back it to 50% potentially, and cash in the initial coin offering, they cash in the rest. And if something goes wrong, really wrong, they will be so systemic that the Fed has to bail them out. No, I'm just... That's because there's a huge wealth transfer to Silicon Valley. That was essentially what people want, or what Silicon Valley officials want.
Okay, let's summarize the last 3 questions. Gentlemen here, and then you. Yeah.
I would like to come back to your structure for the EU with the junior and the senior tranche. I mean, this is not a new thing, right? It's been discussed during the Greek crisis, right? So I was curious to know first how it is different compared to the discussion at the time. And second, it is very well known that Trump is very much opposed to the BRICS. And he expressed that by threatening sanctions against new countries eventually joining the BRICS. So I wonder whether this idea will eventually, your proposal may get some traction given those circumstances.
Let's collect questions, please.
May I follow up on these questions, because I think it's interrelated, but I just want to put in the frame emerging technologies again. Whether actually this kind of perspective of clustered unipolarism, which I consider it's my naming of with the idea of operating in semi-closed economies or semi-closed systems of information as well, or data infrastructures as well. So with very strong regional influence. So how can emerging economies actually help on facilitating this clustered unipolarism, which I think is also related with both questions.
Okay, thank you. Now, Luke.
Yes,
yeah.
Very quickly here. On the shift from the old order to the new order, now it's pretty evident with Trump, but it hasn't just started yesterday. So it's few years that we see this switch. So I'm wondering where on timing you put the switch and why. And second question, the old order, or let's say the current order, is underpinned by institutions. We have the WTO, the IMF at the center of the global financial safety net, the G20. How you see the new order, the five polar, is going to be governed by any institution, or we deinstitutionalize the order?
Final question, please.
Yes, I have a question on the exorbitant privilege and the implication of a move to a multipolar order. Because you pointed out that this term of the intertemporal budget, the bubbly term, is bubbly, it has its fragility. I think you wrote in your article of a Laffer curve of debt. So, in other words, countries, even very strong countries, there are limits that go in bubbling, in mining the bubble, as you put it. So, do you see any, especially say from the point of view of the United States, which is by far the one who has the most potential in mining the bubble, whether actually the move to a multipolar world may undermine their ability to do that? And what Europe could do in this respect?
Yeah, so right now the US, I would argue, has this privilege, this exorbitant privilege, to mine the bubble in a sense. So it can issue some government debt. It has to be, in case of emergency, it has to back it up with fiscal resources. But only when you jump out of this good equilibrium to a bad equilibrium. Now, they have to be able to do that. So you only have to threaten off equilibrium that you're able to do it. Then you can stay in this position. But the Trump administration seems like this to destroy this big privilege the US has. And then, of course, it's a privilege to be in this position, but also everybody of us, the whole financial system relies on it. And if they destroy it, it's not only costly for the United States as a government, it's costly for the whole world. And the question is, how should we position ourselves in this transition on this? And that's, that leads me to the question from your neighbor is, I don't know how the next five-polar world, whether it will be five polar, is speculative. I don't know how it really will look and when it started and whether we're in this transition. I think we definitely, and it could also be that we might go back to the old world, no? If something happens. It could be we end up in a big recession, people realize this is all the wrong way, we make a U-turn, and we go back to the old unipolar US-centric world. I wouldn't rule this out either. So I'm just laying out a potential path, a potential scenario, and if you're resilient, you probably want to prepare for this a little bit and say, what is the best response? Think about it now and come up with some crazy thoughts in this dimension. So let me just, so the SPs, that's, yes, indeed, it was an idea created during the Euro crisis, and it's the same as it is before. It just now might be a time to revive this idea because of the new situation we are facing. And I should say it was very close the first time around. It was essentially killed by the next generation EU bond because suddenly they say, oh, we have now this resolution of the whole problem. And the PEP, the central ECB, just stepped in. That was possible because at that time inflation was too low. Okay? But if the inflation is too high, you have no reason for the ECB to step in and buy huge amounts of these bonds. So we have a different situation now, but there's also a situation where this idea actually might find a revival. That's something. Then the clustered thing. So I would say, so if I understand it correctly, that there's a center and then there's some other clusters around it. That's a little bit like the old world order. But you have one where there's strict fragmentation from a technological perspective. Like, did I understand this? Like China, you can't use Google there and things like that. Yes. So I don't know what the future will look like, but from a technological perspective, I talked about the financing, but you could do the same thing from a technological thing. So we're very dependent on US technology. If the US shuts down the GPS, whoa, they can shut down anytime. Google says, okay, we shut down on a Google search engine, AI, everything is shut down. In principle, they could do it. I don't think the global companies do it, but it could be that at some point Europe says, oh, we want to get against these tech giants, and the tech giants said, oh, that's it. You without Google. Do you want that? That's correct. But this is essentially, the modern technology is a choke point, and it's a power that could use. And I can see with the trade war, let me just make a crazy scenario. Trade war saying, okay, we go against the tech giants in the United States. And Trump says, okay, fine, you live without them. And then there's no search engine in Europe. So then you say, okay, the Europeans will build up their own technology. How quickly can they do it? This is just an extreme risk scenario, no? But anyway, I shouldn't speculate too much. Did I answer? Oh.
Thank you very much, Professor. Just a very brief question, if you allow me. You talked about the exorbitant privilege. If we take into account the estimates of Federal Reserve, in 3 out of the past 6 quarters, the real interest rates in the long run was higher than the annual potential growth pace in US. So it seems that US is losing this privilege. And to what extent these recent developments explain the divergence in terms of the developments of the stock market, US versus Europe in the first quarter of this year? Thank you very much.
I can only speculate. So I think, so if it's R versus G, I think the real interest rate in the United States is typically lower than the growth rate. And this gives you some potential to have a large exorbitant privilege. And I think that's the second question was, this first one was R versus G, and the second one?
According to the Federal Reserve, the potential growth pace for US, the growth pace in the long run is 1.8%. And in 3 out of the past 6 quarters, the real long-term interest rate was higher than this 1.8%.
Yes. So it can go up and down.
Yes, but in 3 out of the 6, it was higher.
Yes, but you can also finance yourself. So you see it already in the United States. You go much more to the short end of the yield curve. You don't have to issue the 10-year treasury. You can issue, more T-bills. And you see this already. And that at the end, at the short end of the yield curve, you get a much lower interest rate. And that.
Definitely last question, please.
I have a preliminary question before the real question, just to understand if I...
One, please.
Yeah, though, the question is, what you said about the West's best response to China's strategic industrial policies is your take, or is one of the possible conclusions under different IP theories, or it's your take, it's what you are saying, like the sophisticated response?
It's my take.
It's your take. So the question is, well, in Europe, we've seen in the news that Europe is flooded with Chinese goods. And if you focus on green goods, there was your focus also on saying we should take cheaply subsidized Chinese goods like solar panels and saying thank you. Well, with the current situation, and I agree with you on the idea of thinking about a sophisticated solution, and anything would be more sophisticated than just slamming tariffs, as we know from yesterday, on partners, on commercial partners. But we have to take into account that the European Commission, for example, set countervailing duties on EVs imported from China. And especially now, if China will retaliate against the US by, for example, devaluating the currency, we're going to have to expect more flooding of these goods. So maybe we are not saying thank you to the Chinese, but we should say thank you to the Americans. But it's not a thank you, it's more another expression that I wouldn't use.
No, I understand. Let me qualify. I don't say we should just take all the technology. If it's a particular good where we don't see any big innovation going forward, and the Chinese will not have a huge lead subsequently. For EVs, it's very different. No? If we just let the EVs come in and drive out, because they're highly subsidized and unfair competition, and the drivers our car industry, and we cannot easily make the switch to EVs, it will also in the long run, we lose the innovation in that space. So one has to take the innovation aspects into account too. And it might be better for the world, as for the whole global situation, for the environmental situation, if the Chinese cars, the EVs, are pushed to Latin America and other parts of the world and replacing the stock of cars there, and Europe develops its own EV cars. So the innovation aspect, I think, is very important to take into account too. But it just a blanket reaction, I think, is not the right thing. But there has to be a sophisticated thought process behind it. And as I tried to express with this elasticity substitution, just thinking through the production chain is already complicated.
Okay, we have stretched the time frame. I think this proves, Marcus, that you need to write a new edition of your book, The Resilient Society, this time not focusing on the pandemic, but on deglobalization or global fragmentation and so on. I think you gave us an excellent foretaste of what will be the new chapters in that book. Thank you so much for sharing your insights with us. Let's be back in 15 minutes. Thank you.
So it's a real pleasure here having Pietro, Raphael, and Martin with us for the third academic session. I think the way this session came out and the composition of the three papers is particularly interesting. And really the first two papers will be focused on the methodologies for risk assessment. The first one using really looking at the growth at risk methodology and applying in the case of the EBA adverse scenario. Also look at how the specification of the models for risk assessment behind the growth at risk methodology. Then we will rebuild on this to go to this new methodologies, the one of the data risk developed by the IMF and published in the fiscal monitor of last October, if I'm not mistaken, right, Raphael? Yeah. And then these first two papers really deal more with the risk assessment. Then we will go with the paper of Martin that discuss better how to deal with on the policy side once this on system and in incentive structure that is robust also to enforcement problems, enforcement dilemmas, and in particular building also on the experience of the NGO and the RRFs. And a few words about the three presenters of this session. So Pietro, and here you have to forgive me for looking for. So Pietro is an economist at the European Investment Bank that has joined quite recently. If I remember well, he was a PhD from Pompeu Fabra. And then since then, he has been working most of his time at the IMF with a little stint at the ECB, working on fiscal policy, fiscal issues, but also on risk assessment issues. Raphael Lam, that we started together at the IMF back then in 2007. And also that was another time in which things seemed very calm and then turned out to be extremely intense. He has developed all your career at the IMF and is now Deputy Division Chief in the the Fiscal Affairs Department in charge of the Fiscal Monitor. Martin Large has been at the European Commission for all your career as well, if I'm not mistaken.
25, yeah.
20, yep. And now he's the chief of the Secretary of the European Fiscal Board after having worked extensively in ECFIN and deal with many also research and policy issues. So, without many other things, just some orders. We will do all the 3 presentations, and then we will leave time for Q&As. So if you have questions, please note them down. Leave them for the end. For the speakers, 20 minutes each, and then I will try to give you little warnings, sign messages or so. So let me give the floor for Pietro, and encourage him with a round of hands, please.
Okay, thank you very much, Giovanni. And thank you everyone for the invitation and for hosting us today. I'll also take a second waiting for exactly the first slide to fire up. This is a joint work with Luca Gattini, both of us at the European Investment Bank, and of course these are our own views. So in this work, essentially we ask a couple of questions. One is, how severe are the adverse scenario in EBA's stress test? And this actually, you can see this question more generally as trying to provide an assessment of downside risk to euro area growth. And the second question that we look at in the working paper is try to understand a little bit better from the point of view of a practitioner whether this model, growth at risk, that we use in this empirical work can actually be a useful tool, and what are some of their advantages and some of their disadvantages. In the presentation today, I think that I will focus most on the first question. I think it is the most interesting from a policy point of view. And then we'll see also if we have time to cover the second part. A preview of our conclusion. So the EBA adverse scenario tend to be significantly more severe than our chosen metric for risk, which is the 10th percentile of the model implied growth distribution. And this will make probably more sense in a few minutes when we describe a little bit better the model. In other words, the likelihood of materialization of the EBA adverse scenario is rather low. 2021, which is essentially the COVID year, is essentially the only instance in our sample when our metric of risk is aligned with the EBA adverse scenario. And again, later we'll go a little bit deeper and see what exactly this means. But it is also true that this scenario from the EBA fall inside the probability space that is defined by our model. So they are indeed severe, or we can say very severe, but they remain plausible, which is also one of the requirements from a regulatory point of view. Regarding the second question that I showed earlier on, so how useful are growth at risk models in empirical work and in policy-oriented work? We think that they are indeed a useful risk compass. We see less scope for this model to do forecasting work. I'll spend perhaps very quickly a couple of minutes on the context, the macroeconomic context that we are in, and this sort of came up also in the previous presentation. Back in the days when I was doing my PhD, the big word was the Great Moderation. So essentially it was kind of the end of history. Everything was smooth, everything was well-behaved, and also a lot of, I would say, the work and the thinking that was happening on the academic side and on the modeling side was about perfecting the models. And that, in the last few years, has changed dramatically, and there have been a number of crises. Many shocks, the macro background has become a lot more volatile, and clearly this has also made the job much harder for policymakers, because it becomes a bit definitely more complicated to implement effective policies in an environment that is changing a lot and that is changing potentially fast. And of course, this also shifted a bit the priorities for academics, for economists, in terms of developing tools for forecasting and risk assessment that are more flexible and also able to capture, to better capture and to better represent tail risk. And there have been a number of works, contributions that have come out in the last few years. Some have focused on adapting traditional models, be them dynamic stochastic general equilibrium model or time series model. Others have tried to incorporate novel features into otherwise rather standard macro model. For example, they have come up with a pandemic block and the likes. And then we have also been, there have also been those who have investigated machine learning and other techniques, both showing some advantages and disadvantages for policy work. And then there is also another stream of the literature that has been working and introducing these growth at risk models. And here I'm going to spend a few words to introduce these models to you. Since in this panel you will see them again in Raphael's presentation, and some of them were also mentioned by one of the other panelists a little earlier on when he presented a slide on the quantile VAR. So they are, all these models, they all find their inspiration, if you wish, from the same roots. That is to provide a probabilistic assessment of future output growth by fitting a continuous distribution to a set of estimated quantiles. Now, for the non-technical guys in the room or in the audience, essentially, we are looking at models that are built up from quantile regression. So regression that envisage a linear relationship between the dependent variable and the independent variables, but they look at different quantile of the data distribution, and by so doing they try to capture non-linearities in the relationship between the variables. And then where GAR models go one step further is essentially to impose a continuous distribution, a probability distribution on these estimated quantiles. And there are different ways for doing that, but this we'll leave it aside for this presentation. GAR models are non-structural models, so there is no micro-foundations. There is also, let's say, no theory-inspired restrictions or identification assumptions. So we are looking essentially at correlation and reduced form relationships. And they are state dependent, so they definitely depend on the information that is fed to them, and they also depend on the moment in time when these models are estimated. And we will see some of them in some of these features in the empirical application. One advantage of these models is that they typically are tractable, so they are not particularly difficult to estimate, which is indeed a good feature for those doing policy work. And they are also rather transparent, I would say, in the way that they work and how the result can be interpreted and understood. Let's now dig a little bit deeper on the data side, and then we'll discuss some of the results. So in our application, we focus on euro area data. So we have a euro area-wide series. The dependent variable is cumulative real GDP growth, 3-year cumulative real GDP growth. Why? Because the EBA typically express the severity of their downside scenario in terms of 3-year cumulative real GDP growth. And then we try to to explain the behavior of growth through a series of control. Clearly, we have lagged GDP. We have the KISS, which has already come up in earlier presentation, which is a measure of financial stress in the euro area. We have interest rate, long-term and short-term interest rate, credit to the private sector, house prices, the real effective exchange rate, oil prices, and export of goods. And of course, we try also a different combination of this regressor. We try also we look also at other controls, but this is kind of the setup, the basic setup that we use. On the choice of the independent variables, I'm not going to take too much time on this. They are pretty straightforward. We are trying to explain the behavior of future growth and the downside risk to growth in the euro area. So clearly, because even of the time series property of future growth, we control for current growth. We want to control for what is happening on the financial market side, and that's actually where most of the literature has focused so far. And the contribution of financial market and financial risk to downside risk to growth in the country of interest. We are, of course, looking at interest rates, which are a determinant of growth as a reflection of the monetary policy stance. Credit to the private sector, house prices, all these variables clearly play an important role in explaining growth dynamics. And then, real effective exchange rate as a measure of external competitiveness. Oil prices could be a proxy for commodity prices. And then a good export, we hope that it can help capture some external demand. Our sample goes from the mid-80s until 2024. Here again, it's kind of a choice. We could work with post-euro area data. Here we input those that were not available. In our baseline empirical application, we just decide to give preference to having a long sample of data. Now, back to the question asked in this paper. So how severe is the adverse scenario in EBA stress test? And the question, we've asked this question at the EIB from a very if you wish, concrete problem or demand that we are faced with, and it is we have to design a stress test. Being a bank, we have to design a stress test. And one element, if you wish, the incipit of a stress test is to design a downside macroeconomic scenario. And in doing that, one very, let's say, obvious and reasonable question that one can ask is, but how severe does the downside scenario needs to be? And there can be different answer to that question. Here, we are trying to provide, to put it in perspective through the lenses of an empirical model and of this growth at risk framework. And here, this is, I think, a bit the key slide, or one of the key output of the paper. There's quite some stuff in this slide, so I'll take a bit of time to go through it. But after this, I will say that most of the effort will be over, and then we will be wrapping up the policy conclusions. So here, first of all, we have a few different years. The EBA runs these scenarios every other year. So we are starting from 2014. There are also a few other occurrences before, but we decided to start in 2014. Then we have 2016, 2018. We are skipping the 2020 because there was the COVID. So the publication, the scenario was postponed to 2021. And then we have the last couple of years in 2023 and the most recent one in 2025. And in this picture, we can see one of the two vertical bars that is the severity of the EBA scenario. So that's the 3-year cumulative growth. In this case, it's typically a negative number that the EBA set as the severity of its adverse scenario. So, for example, and then I also have a table where we can read it better, but this number in 2014 was around minus 2.6%, most likely. It stayed at about that severity also in 2018, and if we look at 2023 and 2025, we were around 6%, so a 6% cumulative fall in real GDP over a period of 3 years was the downside scenario envisaged by the EBA. And the question that we ask is this severe? Is this severe enough? Is this not severe at all? And when we run our model, we actually find that these scenarios are typically rather severe. As you can see here, we are plotting the probability distribution function across different models, so from light blue to darker blues. We are adding control, so we are kind of testing a little bit how stable the model is across different configuration. But what we see is that the EBA is consistently to the far left of the probability density function of real GDP growth. And if we pick a measure of risk, which is what we call here GAR 10, so the 10th percentile, so the mark, essentially, of severity, which has a probability mass of 10% to its left, we see that this is often more conservative than where the EBA downside scenario fall. And the only exception is in 2021, where the two vertical bars are reasonably close. Here is just focusing on the 2021 round. The point that we are making here, beyond showing this graph a little bit more zoomed out, is what I was mentioning, alluding before, that the result, the outcome of growth at risk model are time dependent. So here we use information in the top graph in the fourth quarter of 2020, and you see that we are getting a probability distribution that are centered around 0 cumulative growth over the next 3 years. But if we fed the model, if we started our out-of-sample forecast from the previous quarter, which is during the depth of the COVID crisis, because Q2 in 2020 was definitely the worst quarter, then the model would have picked up an even harsher severity, and our projected growth outcomes would have been considerably more severe and around -5%. Now, out of this table, I'm going to use this to wrap up. So here you can see in the first line the severity of the EBA adverse scenarios in numbers. So these were some of the vertical bars that we have seen before. And we can see very clearly that the severity of this downside scenario increases over time. So in 2021, during the COVID, it was a -3.6% cumulative fall that has become a -5.9% and a -6.3% in 2025. So the severity of the macroeconomic adverse scenario has increased. This doesn't necessarily square well with what the model is telling us, what an empirical model would tell us. Our measure of the GAR-10 of downside risk has been recovering in the last couple of years. And if you look through some of the other measure of risk, the likelihood of a recession, you could also see that this has been improving, so in reflecting generally a less risky macro environment, at least compared from the COVID times. So some of the key takeaways of this application. In the last few years, the gap between the severity envisaged by the regulator for the downside macroeconomic scenario and an empirical measure of risk and severity has been widening, which points to the fact that the downside scenario from the regulator have been more conservative over time, at least seen from the lenses and the perspective of the model. The likelihood of observing outcomes worse than the EBA, around 2%. So whether it is too low or good enough, it's not up to me to say, but one could certainly make the policy point that a closer alignment of the EBA adverse scenario with the probabilistic metrics like those that are coming out from a GAR model could enhance the relevance of the stress test and perhaps mitigate some of the risk of excessive pessimism in having scenarios that are, yes, plausible, also from a probabilistic perspective, but to the very left tail of the growth distribution that is suggested by an empirical model. Now I leave it to the next presenter to show you some other application of these very same methodologies.
Indeed, thank you so much, Pietro. A round of applause for. Thank you. Let me give then, as suggested by Pietro, the floor to Rafael. Also for you, 20 minutes. And please. Just wait a second, they need to load. Here we go.
Okay, thank you for the invitations, and my pleasure to be here and present a joint work with some of my colleagues, Davide, Domenico, and Fasan. All of them are working at the fund. It is about the debt at risk. essentially, we are trying to do similar things, building on the growth at risk literature to forecast the future distribution of the public debt. So maybe as a motivation, I think many of us knows that the global debt is elevated at about 93% of GDP last year, and could rise more than anticipated in the future coming years. So certainly high debt will reduce the fiscal space available for spending, but also raises the risk of the sovereign stress. So the challenge here, or the point that we in this presentation, is to try to quantify the full distribution of the public debt for the coming years for a wide set of countries, which would help better assess the risk surrounding the debt outlook. So in this presentation, we propose a novel debt at risk framework that is building on the growth at risk methodology. Pietro has already introduced it, and it's also building on the 2019 paper by Toby and Adrian and his co-authors. So basically, we are running a panel quantile regressions for quite a large set of countries, over 90 countries, in order to predict the quantiles of the future debt for the next year until the next 5 years, so next 1 to 5 years ahead. We then estimated, after obtaining this quantile regression of where the debt level lies, we inverse back to the full distribution and trying to fit it to a skewed T distribution. Then we kind of make all the densities conditional on multiple variables and then aggregate them to a single distribution to form the full distribution of the debt for individual countries, for each of the 90 countries. And then we also aggregated to form a global debt at risk by using the GDP rate. So what is the reasons why we want to get a better understanding of the debt at risk, or the risk surrounding the debt outlook? Certainly, we can go beyond the proximate drivers. For example, usually we can think of the growth, the primary deficit, the interest growth differential as a driver of that. But in this methodology, we're able to use the regression approach to kind of pinpoint maybe some of the debt is also driven by the financial conditions, the social or political economic conditions, and some other variables. It also allows us to export on nonlinear, very complex effects on the debt distribution that I'm going to talk about. And then certainly once we have a distribution, we could do a lot of risk assessment, understand much better about, in an extreme adverse scenario, what would that look like. And of course, we can also analyze the spillovers, the strong correlation about countries on the debt distribution as well. So to preview the results, we are able to predict strongly, statistically, coming from the different set of the variables to predict the debt risk. And it is referring to the entire distribution, not just the baseline projections of where the debt level is. In a sum of the key results, we find that the global debt at risk is about 20 percentage points higher than our own forecast, which is a pretty extreme. At the 5 percentile, at the 95 percentile, the debt could rise to about 116% in the next 3 years or so. Certainly, I mean, because we have 90 countries, and one could assume that also these countries, the debt at risk are different. Advanced economies will be higher than emerging markets, but also the drivers of those, the debt distribution will be different across countries. And by having these measures, we are able to better predict the occurrence or the likelihood of a fiscal crisis, much better than the other typical economic indicators. So to go through some of the methodology, maybe we could start with the data. It is starting from 1980 to 2024. So it doesn't account for the recent uncertainty with respect to the new administration. 90 advanced and emerging developing markets. So basically it's over 90-some% of the global debt, very representative. The key variables that we put in our analysis would include the financial side, measuring by the financial condition index provided by the fund, as well as the stress index that appear in the literature, and of course the sovereign spreads. We also include some of the political variables, including the uncertainty index, both at the world level economically, as well as some of the measures of the social unrest indicators. On the economic variables, it's basically very typical, the debt to GDP, deficit, and R and G from our own forecast. So maybe we could quickly walk through the empirical estimate of the quantile regressions. Essentially, the left-hand side is the debt to GDP ratio for each country's 1 to 5 year ahead in terms of the projections. On the right-hand side, we mentioned about the set of the financial, political, and social variables, which is the X here. The interesting parameters that we are estimating is the beta, which is the effect, the marginal effect of each conditioning variables on the debt to GDP, which we call the location parameters, which is basically shifting the entire distribution left or right, depending on the sign of the beta. More interestingly is the parameters on the gamma, which is we call it the scale parameters, that essentially captures how the tails of the distribution shift over time. So the joint effect from the quantile regressions of those predictors will be the beta and the gamma. Let me show you quantitatively or conceptually how it works. So suppose that the many factors that drive the distribution of the debt in the future, certainly if we just think of the location parameters, the beta, if it's positive, meaning that, for example, an increase of the deficit will certainly increase the debt level. So that will shift to the distribution to the right, from the black to the red line. But that would not change the tail of the distribution. However, if the gamma, the scale parameters, is also positive statistically, then it means that the right hand of the tail, meaning the downside risk of the debt outlook, becomes much more likely. So some have a flat tail on the right side. And together, it will shift the debt distribution to the right, but also with a flatter tail. The interaction effects in some countries may be more complex because in some cases, the beta parameters may be positive, whereas the gamma, the scale parameters, is negative. So they kind of offset to each other. So in some cases, we are able to observe that whereas the debt level have shifted up, but the risks have come down in some years. So once we have these quantile regressions to predict the debt level for individual countries, we try to fit it back to the whole distribution. We then pool some of the densities by estimating the weighted sum of the densities, making sure that the weights would add up to 1 by maximizing the out-of-sample accuracy of the combined distribution. Then we enact the individual countries' quantiles to form the global debt quantiles, and then again we inverse it to get back the distribution. Let me go through some of the parameters, what we find in terms of the importance of the driving factors for the debt distribution. So here we show the different conditioning variables, for example, the financial conditions, the sovereign spreads in the middle, and the social unrest. What we want to draw your attention is the red line, the red bars in these charts. The horizontal axis shows how the debt distribution is for the 1 year ahead to 5 years ahead. So let's take an example of the financial conditions, which means that, for example, when we observe a high red bars, for example, on the 3rd year, means that the financial conditions is important in driving the tail end of the distribution at the 95th percentile, which means that if there's a deterioration of the financial conditions, it doesn't only shift the debt level to the right, but it also increases the density of a very high upside risk in that situations. And you could see that for these distributions or for the conditioning variables, they are different. Sometimes they are significant, sometimes they are not. So the methodology will be able to allow you to distinguish or to identify what are the important drivers of the debt distribution. For example, the sovereign spreads are very important in the near term, but then it's faded out. Whereas the financing conditions is particularly important in the medium term at the 3 or 5 years horizon. We do that for other variables on the economic factors. All the signs probably expected. For example, an increase in the debt to GDP would also increase the future debt in the coming years. But these results will show that it's not only increasing in terms of the level, but also shifted to the right tail of the distribution. On the primary balance, it is also important in the sense that when we think about the fiscal consolidation or fiscal adjustment, we also think only about how it's scaled back on the debt level. But here, the red bars is actually pointing to the fact that it's not only reducing your debt level, but also reduces the chance that you will end up in a severe scenario. So it has basically, undertaking fiscal adjustment has two positive impact on the debt distribution. And here is just basically we split it up between the parameters of beta and the gamma, and we find that both of them are significant but asymmetric depending on the conditioning factors. So sometimes, for example, in the financial conditions, they are important on the tail end of the distributions on the gamma parameters, for example, in the third year ahead. This is a distribution, how it looked like 3 years ahead for the 2027 in terms of the global debt at risk. Essentially, we centered the median at our own World Economic Outlook projections is about 97%, but at the 95th percentile of the debt distribution, it is about 20% of GDP higher. The methodology also allows us to kind of distinguish what are the driving forces of the distribution of the tail end distribution. For example, we started with the medium projections, the baseline projection in 97. On the right bars, on the red side, you see that the 95th percentile of the debt distribution. So what are the driving forces? At a global level, primarily it is driven by the government deficit, although the financing conditions are also important factors. If we look at the upside and the downside risk, we certainly will see that the red line, which basically shows the debt at risk at the 95th percentile, trades pretty much in line with the developments of the baseline projections on the debt, which is shown in the black line. But when we compare the upside and the downside risk, meaning we're comparing the distance between the 95th versus the baseline projections, or the 5th percentile versus the baseline projections, we can see that the red line is always above, meaning that there's always a strongly upside risk to the debt outlook relative to the downside risk. Here is the same projections or the distributions, but split it out across advanced and emerging markets, developing countries. Certainly the levels are different, but also the right tail of the distribution is also have different densities. Particularly, we see that at the 95th percentile for the advanced economies is about 20 percentage points higher. Whereas on the emerging markets, they are relatively less, the distance between the debt at risk as well as the baseline level. Not only that, the primary driving forces are different. Deficit are the primary driving forces of the distributions of the debt, but on the emerging market side, mostly is driven by the economic uncertainty or policy uncertainty, which is the tallest yellow bar on the right side. So this methodology allows countries to look at what is the important driving forces of the upside risk on the debt outlook. Then let me illustrate one application of the debt at risk. In the fund, we always think about can we predict or can we kind of think a little bit more to see what is the risk associated in the coming years. One of the risk that we see will be the fiscal crisis or the debt distress. So basically, as the debt at risk measures is able to help predict or better forecast the occurrence of the fiscal crisis. If so, I mean, how well does it perform relative to other available economic indicators? So to address this, we basically need to think about what does the First of all, we need to create a variable called fiscal crisis. And here we follow the literature. Basically, so any one of the 4 criteria, whether you have a very sharp increase in the sovereign spreads, whether you engage in a default or a technical default in terms of a debt repayment, or whether you engage with an IMF program or the one with the European Union. And the 4th is some of the discrete variables that we measure in about debt restructuring has occurred or not. So we try to estimate what is the likelihood of the fiscal crisis versus the debt at risk variable. And we propose 3 methods. Basically, is I try to do a robustness check. The first is a no-JIT model, which is very simple. We're basically asking if there is a left-hand side is a fiscal crisis, what is the probability of a fiscal crisis, conditioning on the key common conditioning factors that we put in the debt at risk. Here, you can see that almost all variables are statistically significant. For example, a 1 unit increase in some of these indicators will push up the fiscal crisis by about 8 to 11%. And that is economic significant considering fiscal crisis is a very low likelihood phenomenon that are observed in the data. To make sure that we get the right result or these results are robust, we do this Bayesian modeling averages. Essentially, we're basically asking, which is on the left-hand side, asking whether it is reasonable to include these variables as a predictor of the fiscal crisis. A high bar meaning that that variable should be included as a predictor of the fiscal crisis. Using this model, we are able to kind of find that most of the factors that we put in the conditioning factors are important and should be included as a predictor of the fiscal crisis. On the last bar, which is a combined distribution, as a debt at risk, the distance between the 95th as well as the 50th percentile interacting with the debt at risk to see. And this is about 1, a very strong likelihood that it needs to be included as a predictor of the fiscal crisis. We also have some out-of-sample results, which also shows this is a very high level, maybe not at the 1, but it's still at more than 0.9 in terms of the BMA model results. On the 3rd methodology, we try to use a machine learning approach to throw in like 19 categories of variables with about 600 kind of permutation variables along listed on the right horizontal axis, including the debt at risk measure that we created, along with a common variable, for example, the debt level, R minus G, external debt, the debt services, or even inflation and other institutional factors. And we find that the debt at risk approach is actually one of the best predictor in terms of forecasting the fiscal crisis. There are also some other extended sample. For example, we try to extend to more than 170 countries. Of course, the set of the countries data is available is less, so we only focus on the economic indicators when we do the debt at risk estimation. To conclude here quickly, maybe the debt risk is elevated and certainly tilted to the upside. In terms of number, it's about 116% of GDP in 2 years ahead. And it is one of the most robust predictors for the fiscal crises. And in terms of the policy implications, I think we provide an approach to quantify the debt risk by having the full distributions, and it is applicable to a wide set of countries. Maybe for policymakers, one could compare the risk over time, just like Pietro mentioned, how does it evolve over time, how does it compare across countries, and certainly could be useful indicators for the early warning for some of the monitoring for surveillance purpose. Thank you.
Thank you, Rafael. Very good and very perfect, right on time on your 20 minutes. Yes. All right. So your last points link very well with the presentation by Martin that is more focused on the policy response after the risk assessment, which is, I have to say, I'm a big I like a lot that a risk and a growth, a risk methodology, because they really managed to quantify and visualize risk, which is always something that is difficult to say. Please, Martin, the floor is yours.
Thank you, Giovanni. Thanks for having me on this panel. It's great to be here. So the two previous presentations, they showed how to gauge risk. In my presentation, I'm looking at how Europe and the euro area dealt with risk that materialized and possibly about the prospect to improve the resilience of the system. My presentation is part of a work that I'm doing at the Institute for European Policymaking, of which Catherine de Vries, who was here before, is the chair. It's a commission-sponsored project. That said, the usual disclaimer applies, so my views do not reflect those of the Commission, the European Fiscal Board, or the Institute of European Policymaking of Bocconi. Now, since we are at the end of a very interesting day with lots of interesting discussions, I thought forward and reasoned backward. And instead of now presenting lots of numbers and different concepts, I tried to put together a sequence of lighter, let me call it like this, lighter exhibits that I nevertheless hope will convince you of my argument. So let me then start with the first exhibit. So this is what we, those who have been working on EU fiscal governance and the EU budget over the last decades, well known. So we have these recurring calls for a bigger budget or a central fiscal capacity, or there are other names. And if you like, here I have just listed the most recent such calls. And you could go back actually in time. Effectively, every more or less important programmatic document about the future of the economic integration in Europe had, as an important element, had this call for a bigger budget. And yet, here we are, and we are still calling for this budget for central fiscal capacity. So this is the starting point, and this is the dilemma that we have been facing now for years. And I would be the first one who would sign all petitions for a bigger budget for a central fiscal capacity. Now, the underlying dilemma I have tried to illustrate with this quote here. And I don't know, those who may have seen the slides before, they know who the author is. But if you have not seen the slides before, then after reading maybe these two sentences, you will be surprised that this is none other than Giuliano Amato, an Italian, a former Minister of Finance, a former member of Vice President of the Convention of the Future of Europe. So certainly someone who is a convinced European. He said this not so long ago, in fact, at an event organized by the Institute for European Policymaking in March last year. He said this probably with the wisdom and liberty of someone who is no longer in office. But what he essentially says is, I mean, if you just look at the second quote, if I try to synthesize it, it is not credible to try to be more European with the money of others. So that's what he said, and which is, I believe, still the underlying problem of why we are still calling for a bigger EU budget, and why we don't get one. This dilemma is, of course, not new. When the current architecture, or at least the basics of the current architecture, were designed at the end of the 80s, beginning of the 90s. The issue was well understood, and here I'm just again showing you another exhibit. This is a note from the archive of the Delors Committee. So these were the internal communications between the members and the experts. And this one looked at the macro-fiscal policy coordination in EMU, so it is well understood that, in a situation where, and here I quote, where you have a divergent and persistent divergent propensity to run deficits, then something can go wrong, and you need to control that. And here, this is the related exhibit. So you see that they already had a very clear understanding of what can go wrong. Just look at the yellow highlights. If a particular government encountered refinancing difficulties, there could be strong political pressure, blah, blah, blah. Citizens of other member countries would effectively be taxed. So that was the understanding, and that's why the Article 126 and 121 were included effectively later in the treaty. Now, if you accept this setup, then I've tried before. I've tried to model this in a simple way. I've tried to visualize on the left-hand side how the original Maastricht architecture was meant to work. And here, original Maastricht architecture, I use just maybe also as a more technical word for public finances at EU level more generally. Because most of the times, at least in the part where I work, the EU budget and the fiscal rules and other elements, they're usually discussed separately. But I'll try to argue, or I will argue, that there are interactions that then lead to very specific problems. So on the left-hand side, you have my visualization of the original Maastricht architecture. So you have a relatively small EU budget, which then later was embedded in the multi-annual financial framework. And that's what I call the agreed redistribution. So it's based on the treaty, it's agreed ex ante, based on EU law. This is what the member states control. They are net contributors, they're net beneficiaries, and there are these two groups of countries that have different propensities and widely divergent propensities to run deficits. But then, as I told you by showing the previous exhibits, the architects said, well, we introduced fiscal rules and the no bailout clause, and that's it. That's why I chose this sort of wall-like pattern for this rectangle, and therefore we will have no redistribution by recurring accidents. Okay. But then after 2008, we had to learn that this architecture did not really work as intended. You had still this picture at the upper part. So you had this net contributors, net beneficiaries, and then these two groups in terms of fiscal performance. And this brownish part is just to signal that the distinction between two is not very sharp, but I'll come to that. And then a big shock hit, and then the fiscal rules, did not really work before, and then the no bailout clause became lost credibility, and then some ad hoc redistribution mechanisms were put in place based on accidents. By the way, colleagues at the Bocconi call this then an insurance without a premium. I call it redistribution, recurring redistribution by accident because of vulnerable countries. Now, if you accept this visualization of what was intended and how it played out, then you can try to come up with a more stringent small model, and that's what I have done together with a colleague of the ULB. I say up front that the first part of the simple model is then just a prelude to then an extension of the same model that opens up to potential solutions to the dilemma that I'm going to present. So you have two groups of countries. Again, the distinction is not sharp, but what is important is that the group D, that I will describe in a minute, preserves a blocking minority in the council, the one that the entity that decides about the fines. Okay. So, and then let's assume that this group D enjoys political and economic benefits from running deficits. So this is what also in the law report is then called that there's a wide divergency in running deficits. So one group D, enjoys these benefits, and there is another group S that runs sustainable fiscal policies. Okay. So this is a very simplistic characterization, but I argue it captures quite well what we have observed. And then think of the implementation of the fiscal framework. So here, focus on the fiscal framework. We come to the budget later on. As taking place in 3 stages, and these stages can be more than 1 year, but several years. So in stage 1, Group D decides if fiscal policy if it runs a deficit or not. In the second stage, there is a move of nature, if you like, and an economic shock hits. And then Group D decides whether to ask for help or not. And in stage 3, then Group S decides whether to offer help and under what conditions. Now, and this is now the part that is maybe a bit difficult for this stage of the day, but please bear with me. It's the extensive form of this very simple setup. So you have the groups on the right-hand side. You have the various stages. So on the branch that says ND is when a Group D decides not to run deficits, and then YD and YS are the outputs of the two groups. Then if a negative shock hits, then you have the payoffs attached to the various branches. So gamma is the economic and political benefit that Group D enjoys from running a deficit, but then if a negative shock hits, it may pay a share of GDP, which is XD, and if the council imposes a fine, it may also pay a share that is here denoted as F. So it can ask whether to ask for help, which is HH, or it can say, well, no, actually, I don't ask for help. Then in the last stage, again, the payoffs, the symbols are very simple. In that case, the choice is between for S to offer a transfer, that is a transfer T, but under certain conditions, and that again, that's a share of GDP for Group D. And then if they don't, if Group D doesn't accept the transfer, then Group S faces this spillover XS. And this spillover can be small if the negative shock is small, but we also have observed very large shocks where this XS was at least perceived to be quite big, so big that in fact Group S always was ready to offer a transfer. And so the main conclusions from these extensive forms are like this. So in the event of a very large shock, Group S will provide for financial support, if asked, of course, because it may assess that the economic and political costs, so XS times its GDP, so XS is the share of GDP, is the worst possible outcome. And therefore, it may be ready to to transfer money. Now, Group D will ask for financial support if the conditions that it has to pay for accepting the transfer are not bigger than the cost that it has to carry on its own. So, which already tells you that the conditions cannot be too high. And this, for those who have worked on a macroeconomic adjustment program, they know that, yes, these conditions were tough, but these countries did not accept everything, not even Greece, let alone countries like Ireland, where I had the privilege to work on. So, plus, you can add this, maybe it's a completely theoretical corollary, but non-EU powers may offer help, which reduces the costs for country D, and then you're in a problem. And then, plus, you have this assumption that I made that Group D has a blocking minority, and therefore it will never impose fines. So therefore, essentially, the decision of Group D boils down to whether the benefit of running a deficit is higher than the cost, or lower than the cost of accepting help. And so far, we have seen, at least when big shocks hit, that Group S was willing to accept this bargain, which means that fiscal rules per se lose credibility in this context where you have systemic risks, and Group D may enjoy political and economic benefits in the short term of running deficits. So this is in my view, and the view of my co-author, is a model, a very simple model that captures what we actually have observed. But if you accept the logic of this model, then there is a way out. You can actually think of an extension of the simple model where you introduce just two additional stages. So before the shock hits, Group S should actually have an incentive to offer transfers, a new set of transfers or help to Group D on the condition that it implements reforms and investment. So this may sound like something that you know, like the RRF. So instead of going, playing between the extremes of just giving recommendations, which a senior policy advisor that worked for a long time in Brussels called lifestyle advice, and on the one hand, and heavy macroeconomic adjustment programs on the other, Group S would have an incentive to say, listen guys, we offer you additional transfers in return for reform and investment. Then if you extend this, and then just show this without going into the details, you can look at it at your leisure, then you actually create an outcome, a possible outcome, where you no longer have a situation that Group D will always run deficits and Group S will always pay for help in an extreme situation where markets reassess the risk of sovereigns with high debt, and the whole system is at risk. So I think the idea is to give Group D an incentive to implement reforms and investment and make them more resilient. And you can go through this extensive form again. You can think forward and reason backward, and then you will see that there is a potential to improve this. And again, here the main conclusion of the extended model, and in essence, without going through all of them, the essence is how effective can this conditional budgeting, I call it conditional budgeting, can it be? Or can this conditional budgeting be effective enough? Because if you buy this model, then you will see that the outcome depends on this epsilon, which is a sort of a measure of how effective this intervention intervention is. So the idea is essentially to overcome the dilemma that we have at the moment. We have in normal times we have lifetime advice that is not effective, and then we have macroeconomic adjustment programs because Group S doesn't want the ship to go under and them with it. So why not go for a conditional budgeting? And by the way, this is also the reason why in the public debate, and here I will quickly go back to the visualization here. In policy debate, let me stick to these terms, Group D, when it comes to discussion about an extension or the scaling up of the budget, they say, well, we already have a much bigger size of a much bigger landscape of EU public finances. You are just looking at the MFF and EU budget, but in reality, the EU public finances are much bigger. Look at all the help that you get. Okay, so if you buy all this, then the main question is how effective can this conditional budgeting be? And so it's an empirical question, and as part of my work at Bocconi University, I have access to a number of institutions that are really now looking at in detail at how effective the RRF type of experience is in Italy. The focus on Italy is justified, as you imagine, because Italy is the biggest beneficiary. Almost 1/3 of the total amount of the RRF is pledged for Italy. So I spare you the details. I just let you know that based on the detailed microeconomic analysis that is coming out of various observatories, including the Banca d'Italia, but also an observatory of Bocconi or Open Polis, they actually show that from a micro perspective, these interventions, so this type of policy, like exchanging transfer for reform and investment in normal times, is creating a change that is unblocking things that have been weighing on the Italian economy for decades, like the reform of the judicial system. And here I conclude. So the possible bargain would be then to move then from the left-hand side to the right-hand side again with my simple visualization. There could be a bargain in the sense that you offer this additional help to Group D. In a bigger package where you scale up the budget, making all countries more resilient, and reducing the de facto redistribution by recurring accidents in vulnerable countries. So thank you very much for your attention. Thanks.
Thank you very much to Martin and all the other two presenters. Now times for questions. Ermal, please. I have some also of my own. Please. Yeah, please.
For the presentations, Martin, I'd have a question for you because I found yours particularly pertinent as a follow-up to Marcus's presentation earlier, when we're talking about more safe assets. Now, of course, in the United States, the treasuries are financing the federal government spending, which is 23% of GDP there. So to have more safe assets here, it stands to reason that one would need to have a larger central fiscal authority. So let's say in a couple of questions, in a steady state equilibrium, until what point would you see that expand from the 1% of GDP that it is now? And second, this is a bit provocative, just looking at your last slides, looking at the experience in Italy, looking at the growth impact of the RRF, And again, it's difficult to have a counterfactual because you have the RRF while you've been hit by a few external shocks. But just looking at that, how optimistic can we be about a larger central fiscal authority envelope based on the growth record of the RRF in different countries?
Perhaps let's get to the question from Lucio, then we answer, please.
Yes, thank you. I have a short question to Raphael and perhaps a bit longer question for Martin. To Raphael, I was just wondering whether you have thought of combining your debt at risk approach with some kind of fiscal reaction function that would allow you to reach conclusion about the risk that the country, when fiscal fatigue set in, that the country position then becomes unsustainable because the level of debt results in a primary balance that the country cannot feasible achieve. So just a speculation. For Martin, I have 2 points. One, and actually, which were suggested to me also by the presence of Markus Brunnermeier, who made the point before. One is an integration, not something that you could probably include in your model, but perhaps a consideration that you should bear in mind given the context. We heard before that in time of stress, poor countries insure rich countries. And one may wish to take that into account in your characterization of the setup. I mean, the ex post setup as compared to the ex ante Maastricht setup. In the opposite direction, however, you probably have not taken into account the biggest insurance mechanism, which is carried out through the balance sheet of the ECB. So much more important, I would argue, than all the alphabet soup, EFSM, ESM, so on and so forth. So the second point relates perhaps more directly to the model you present, which I like very much. Personally, I'm rather skeptical about the ability, of this conditioning budget to achieve the risk reduction through reform. But I wonder whether one could think of conditioning this ex-ante transfer to some de-risking of public debt from the balance sheet of the banking sector. Would not this a more controllable result than asking for vague assurances that the great reform with impact on public debt would be carried out?
Thank you so much, Lucio. Just let me add just a question for Pietro so that we can do a round of responses. My question deals a little bit with Luca's critique and growth at risk. In the sense, when we have so much extreme adverse scenario, like in the case of the EBA report, how much can we rely on the policy responses that are, these are models that are built looking at the past. And one can think also that under such extreme event scenarios, the ECB could react differently and the policy response. So how to make it this robust to this type of changes? Perhaps you can, while you can think of the reply, we can start from Martin and we go this way. Please, Martin.
Okay, thanks. No, while listening to the very good question, I looked up, in order to reply to the first one, I looked up a piece, I think it's also based on a longer paper by Guido Tappellini, Rich Fiscal Union, and which I liked a lot. And he says something that I think most of us would agree that since the 1960s, that in a monetary union we need a fiscal transfer mechanism. But Tappellini also says that in order to get there and to make that sustainable, you cannot pile just European debt on sort of national debt and have no control on national debt. So that would be my answer to you. So yes, and in fact I did not mention it explicitly, but I hope it became clear from the presentation. So the deal at the end would be ideally that there is a much bigger budget, including the possibility to issue a joint and several debt. But how do we get there? So just calling for it whenever it seems opportune was not very successful. So therefore, this proposal, okay, whether the RRF is now effective or not, I didn't have the time to go through the details, but again, I was surprised myself in my contacts with the Banca d'Italia, the Bocconi Lab on the RRF, and so on. There are very encouraging pieces of evidence showing that it is effective. We know that there is one part where Italy is lagging behind, namely in the mobilization of funds when it comes to big, large projects. But this, some experts say, was to be expected. Okay, so I think it's still early, but at this stage, it looks like this approach, conditional budgeting, works, is promising. That's also, of course, the official line, but that's why I was looking also for like more tangible and evidence at the micro level. And everyone who has worked on Italy knows that at least since I joined the Commission in 2000, the problems in the civil judicial system were described as a bottleneck, something that is really detrimental for the Italian economy, and possibly even before this analysis, the diagnosis was made, but nothing happened. But now, and here I refer to the annual report of the Banca d'Italia, it seems that real progress is being made. Now, this is the beginning. Then whether this will translate into really sustainably higher growth, well, we hope so. Otherwise, our diagnosis was wrong. Now, on the question of that there's a missing part in our model, that's true, but we are not brave enough to include the ECB in our model. We took a much more, abstract approach. And here I refer to a paper by the BIS, where Claudio Borio, but many decades later, again, was a co-author, where he nicely describes the fundamental interaction or interconnection between monetary and fiscal policy. So the fiscal policy things that we have seen after the big crisis have also been made available, or only to a large extent only be available or feasible because of the fact that monetary and fiscal policy are two sister arrangements of the sovereign that at some point were decided to be arranged separately, one independently, the other not. But at the end of the day, they both ensure a privileged access of the sovereign on resources. Of course, here when what I call T in the model was only made possible to some extent because of something else.
So, I will not try to answer or to resolve the Lucas critique this evening. For that, we may organize a follow-up seminar. But on your question about the usefulness of these models, I think they are useful to the extent that they raise flags on the risk environment. And in being realistic and being a practitioner and not being, a Taliban of modeling power, I would say that combining perhaps different approaches, kind of stress testing the models themselves, so not to rely just on one configuration of the model, but to try, batteries of them, you can get some red flags for future risk. Then, of course, you would have a policy response or a policy intervention. So, you know, and then you would also have to think about the time lags in between, you know, the moment when policymakers step into action and when actually, you know, their action can bear effects on the macroeconomy. But I think that so models and these models can be useful to get a sense of where we are, and therefore possibly of where of the direction, of the policy direction, where we may be going. And the growth at risk can be just one, you know, in a broader instrumentarium that expert, practitioner, and policymaker may have to may wish to use.
Yep. To answer the questions, I think, yes, this is one of the steps that we are doing as an extension. Certainly, I think, fiscal reaction function is part of it, but I think it's what we are after is this nonlinear effect of how to estimate of the conditioning factors. In two ways that we are thinking of the fiscal reaction functions. One is in terms of the fiscal rules, whether the presence or the compliance with the fiscal rules actually affect some of the parameters that we estimate, both on the beta and gamma. We have some preliminary results we didn't present it here, but certainly we could exchange. But we do see in some situations, the tail of the distributions is affected by the presence or the compliance of the fiscal rules. Not alone the fiscal reaction functions, I think we'll need to estimate the coefficients in order to get the nonlinear effect. And in some cases, they are basically not too significant, but in some cases, particularly on the advanced economies, they are quite important. So your point about the fiscal reaction functions is well noted. On the questions whether we are doing the model right, we are forecasting, I think it is one step better than what the fund, at least the fund or other institutions used to do. We tend to only produce the baseline forecast, but now I think because of the environment, the economic environment, the uncertainty ahead, that pushes us to look much more into the distribution, the risk surrounding the baseline. At least in the debt corner, even the IMF usually underestimate the debt. We have some internal estimates, or in some literature and empirical literature, the underestimating of the debt to GDP is quite significant, 5 to 6% over 3 years. So if we can get better understanding of the distribution surrounding the debt outlook, I think it is marginal value added. Yeah.
That's good. Perhaps we have time for one more last question. Enrico?
Yes, I mean, I can ask the question. I think you covered it already in part, but I wanted also to reiterate on this idea of, you know, the fiscal response. This is for Raphael. And the fiscal sustainability. I mean, there are papers talking about the fiscal Laffer curve. So I was wondering if you have that in your model, how, like, your model relates, you know, to the work of B and Lipper, that they have kind of, you know, this idea of the fiscal Laffer curve. So yes, you might reach 160% under some assumption, but you actually might not reach it because you're going to default before that. And this also is a question I get about these non-linearities, right? How do you account for them? How do you account for the fact that the relationship between debt and interest rate might be very different at different levels of debt? And finally, the question I have, and sorry, still technical, is how do you select the variables, right? Because for instance, in the presentation, I didn't see variables like the composition of government debt. You have inflation, you have exchange rate, but I didn't see, for instance, the composition. So how did you go about selecting variables? What are you tossing? What are you including? Thank you.
Yeah. So on the selection of variables, partly it is constrained by the data availability. I think different from the growth at risk, we want to get a wider set of a sample So at the fund, we want to include as many as possible. So in this case, we include 90 countries. So the demand for variables to be included will be quite significant. Certainly, the advanced economies will have much more data, for example, on the debt structure, the currency denominations, but those data are not available for some of the developing markets. So there's certainly a trade-off. And those variables that are not included may also be significant. In addition, we also tried some of the variables, for example, the fiscal policy uncertainty, some of the other indices, but they are not too important in terms of predicting the distribution of the risk. We could talk a little bit how we interacted or could select the type of the indices that we included in the sample. The nonlinear effect, yes, we have estimate, including the initial debt level, which are particularly important because as we have found, the initial debt level matters a lot of how the distribution look like. High debt countries versus the low debt countries, the estimated beta and the gamma are very much different. And that is point well noted. We didn't have time to go through some of the detailed results, but certainly the nonlinearity is important here.
Very good. It doesn't remain other than thanking all the three speakers, Rafael, Pietro, and Martin, for the very interesting presentation, which are super interesting, for instance, for us, the ESM, because for us, quantifying risk and be able to think analytically in terms of risk, because judgmental is very easy, but trying to give a structure, it's always a big challenge, but it's needed to put discipline also on thinking about risk. A big thank you to our speakers and to all of you that remain until the very end of the first day, so a big applause to all.